Hi everyone, welcome to the Business Issues and Family Law part of our class. Today, you're in for a treat. Uh-oh. Ah! Okay, bad phrasing. Good puppy though. Good puppy. Yes. Oh, there he is. That's Charlie. Hi everyone, welcome to the Business Issues and Family Law class. This is part of the my University of Alberta class on advanced family law that I teach with Ashley Taunton of the Edmonton Community Legal Center. Today we've got Raj Manek, who's with us. Raj Manek is with Odyssey. He is a chartered accountant, chartered business valuator, accredited business valuator. He's certified in financial forensics. So we use people like Raj quite often in family law matters when there's businesses involved, either when we're trying to calculate their incomes or trying to find out what the value of the business is worth, or trying to look into financial transactions that have happened. So he'll be speaking on some portions today, and he'll be chiming in when he has some additional comments. So I'm just going to share my screen on the slides here and we can get started.
All right.
For those of you who are part of my university class, we will have a follow-up class where you can ask questions. So make sure that if you have any questions, that you write them down so that we can go over them in that class. I'm hoping to share this class with a few other groups as well, with lawyers, so they can learn a little bit about business issues and family law. So hi to all the lawyers who are watching us. And might even put it in a couple of other places, and I'll probably show my associates. So hi to all my associates in my firm. You'll be quizzed on this.
Lots of pressure now.
Just joking, of course. No one's getting quizzed on this. For the university students, though, there's a good chance that this will be that there'll be a business issue in the fact assignment. That's our intent, to usually have it in there. So I'm glad that you chimed in and you're watching this. So let's get started.
Let's do this.
So tonight, we've got a lot of topics to go through. We'll try to brush through them, try to litter it with some interesting stories. You probably already know by this point that my practice is entirely separations and divorces involving businesses and farms. So this is a topic that I really enjoy. And it's something a lot of family law lawyers struggle with. So the intention is that you can always come back to the slides to help you out when you're practicing law. So tonight we're going to go through income calculation. We'll go through control of a business. So what happens if someone doesn't actually own it, but they just control the business? Sometimes that happens after a separation. Sometimes people transfer shares away. We'll talk about financial disclosure obligations. So we'll be going through that in another class. But we'll speak about some specific rules about businesses here. We'll talk about experts, financial experts, such as Raj, who's joining us tonight. We'll talk about how the courts divide businesses. We'll talk about how we actually structure the transfer of business. So do we just transfer the shares to one spouse? Do we divide a business into two businesses maybe? There's lots of different options. Do we sell a business? We'll go into those. There's certain situations where we're trying to find out if something is property or income. We'll talk about that. We'll talk about share transfer restrictions. So let's say if there's bylaws or unanimous shareholder agreement that stops shares from being transferred and there's other third parties involved, what do you do there? We'll talk about that. We'll talk about some special rules that apply to farms. We'll talk about family trusts, and we'll talk about misfeasance when people use corporations as a tool to try to manipulate family property rights or for other purposes. So lots to go through tonight. Should be interesting, I hope. So let's start with income calculation. So one of the reasons why we start with income calculation is that you'll probably be dealing with this fairly often in practice, is if a spouse owns a business, we need to find out what their income is to be able to calculate child support and spousal support. It gets a little bit more complicated than a usual employee, because for most employees, we can just look at their line 150 total income in their tax return. But when it comes to a business, it's not quite that straightforward. So we might look at a business's expenses, for example. Maybe a person is claiming all of their cell phone expenses as business expense. And really, when we're trying to calculate child support, spouse support, we're trying to compare someone who owns or controls business to what an employee's income would be. So someone who owns a business can write off expenses. There are limits under the Income Tax Act, but some people take advantage of that, and in some ways, the Income Tax Act can be a little bit lenient. So the family courts don't have to follow that. They can say, all right, well, you claim all of your cell phone expenses through your business, but really about half of your cell phone use is personal. So we're going to add back half that expense to your income so that we can calculate child support as if you're just a normal employee. So different situations like that are going to come up. And so child support calculations, spousal support calculations definitely get a little more complicated when there's business. Because it's complicated, I've written a whole publication along with another chartered business value, Agnes Lund. It's called the Guideline Income Manual for Legal and Accounting Professionals. So it's about income calculation for child support, spousal support purposes. And specifically, it has a whole chapter on just business calculations. It has a chapter on, even for chartered business valuers and standards and how they can put together their reports. So let's get into the law a little bit. So generally under the child support guidelines, the starting point is that we look at total income, someone's line 150 in their tax return. But like I said, it's not that straightforward when someone owns a business. One thing is that not even necessarily just business owners, but a lot of people, their incomes fluctuate quite a bit. So even if someone's paid maybe on commission based off of a percentage of sales each year, sometimes incomes fluctuate a lot. So sometimes we look at averages. So the child support guidelines do permit courts to look at a 3-year average. If looking at the most recent year isn't that accurate. Really depends on the circumstances. So let's say we're recording this during the height of COVID right now. It's the first week of January, also known as the week where the Capitol building in the States got stormed. People like that. That might be memorable for everyone watching this in the future.
100-year event, yeah.
So this year, a lot of businesses, their income isn't necessarily reflective of other years. So let's say if a business's income had gone down drastically because of something like a pandemic, then using a 3-year average wouldn't be that accurate. But if it's just normal fluctuations, an average might not be a bad idea. So we can't misuse an average. If a business has just increased earnings over time, we can't use an average to bring down someone's income, for example. But if it is just regular fluctuations up and down, then maybe that's not a bad idea, especially if we don't know what's going to happen in the future. Let's say for oil and gas, fluctuations have been fairly common. So it means finding out if there's been a permanent change in someone's ongoing income. But generally, for most people, looking at the previous year is a good indicator of what someone's income is going to be going forward. Yeah. But we do have to be sensitive to changes that have happened. Before we go too far in depth into businesses, it's a good idea to know how business income is reported. So I tried to put together a little bit of a graph to help explain just the different terms that we use. So most of you are probably familiar with this, but I just want to make sure that everyone's on the same page. So when a business receives money coming in from customers, from sales, we call that revenues. So revenues is before we look at deducting any expenses. So your expenses, like supply expenses, employees, and when you subtract expenses from revenues, what you have is pre-tax net income. So from that, businesses get taxed on their income, and businesses So after that, we have dividends that can be taken out. So dividend is one type of compensation that someone can get from a business. They can also pay themselves a salary. There's certain extents on certain limits under the Income Tax Act, and there's different tax rates that might dictate what someone pays themselves, but they can pay themselves dividends, they can pay themselves employment earnings, they can pay themselves property, their shares can be bought back. But most of the time when we're looking at calculating someone's income, usually we're trying to look at that pre-tax net income that's in the business. Because let's say if a business earns $300,000 and they have $100,000 worth of expenses and they pay themselves a salary of $100,000, then there's $100,000 left. And someone could choose, for example, to say, I'm just not going to pay out that money. And then if they don't actually get money from the business, it doesn't show up on their line 150 of their tax return. And if there weren't additional rules, then they could just pay less in support by not paying themselves out as much from the business. They could accumulate it and then pay themselves out afterwards, after children are no longer dependent. So I bring up profit because there's an additional rule that says that if someone's total income in their tax return doesn't fairly reflect all of the money available for payment of support, courts can include all or part of the pre-tax income of the corporation and any corporation that is also related to that corporation for the most recent tax year. So that's a fancy way of just saying that pre-tax net income can be added back to someone's income. Gets a little bit tricky because pre-tax net income also includes dividends that someone might, or it's before dividends have been pulled out. But in someone's tax return, in their personal tax return, their dividend income is going to look as part of their income. So in reality, we make sure that we're not double counting that dividend. So whether you take it out of someone's personal income or out of the pre-tax net income, just make sure you're not double counting that. All right. And I'm not going to go through all the slides because there's quite a few slides. A lot of it is just so that if you run into a situation in practice, you can go back to those slides to have a look at it. But I'm not going to go into all of the details right now. I just want to give you an overview. So hopefully in practice, you can go back. There are some court decisions that have looked at factors about whether we add back the pre-tax net income. So the most famous of those decisions, or at least the most often cited in Alberta, is Kowalowicz. So that was a BC Court of Appeal decision. And it's been cited by our Alberta Court of Appeal. It had a number of factors about that a court should consider. So we're not just automatically adding back that pre-tax net income. A court has to decide whether it's fair to do so. So let's say someone only reported income because they actually did spend money in the business, but it just didn't show up as an expense in their business. So one example of that is if someone is paying off a debt or buying an asset. In both of those scenarios, it might look like there's income. There might be pre-tax net income, but that's because there's rules that the CRA, Canada Revenue Agency, has put in place to limit how much people can claim as an expense. So when it comes to debts, for example, only the interest portion of the debt can be claimed as an expense, not when you're paying down the rest of that payment. So the rest of that payment is called principal. So there's interest and principal is what makes up your payment. So let's say if you've got a mortgage, let's say it's a $1,500 mortgage, maybe $100 worth is towards interest and $1,400 is towards the principal. Well, a business could only claim that $100. So if they have this big expense, the money is gone, it's not profit that's still there. So in that kind of situation, the court probably shouldn't be adding back the pre-tax net income that relates to that money that's not actually there. It's not money that's there for support purposes. It's money that had to go towards a legal obligation. And so the CRA doesn't let you do that because you're accumulating equity. You're paying down a debt, so your wealth is actually increasing. The other scenario I mentioned, if you buy certain assets, depending on how they're characterized, the accountant may have done something called amortizing it. So amortizing means you take the price of that asset, you spread it out over a number of years. There's different rates depending on the type of asset. And there's different names for it. So sometimes people also refer to this as depreciation, as assets go down in value. That's not really the intent of the Income Tax Act. The Income Tax Act calls it capital cost allowance, or CCA. But it all just means whether we're talking about amortization, or CCA, or depreciation, usually we're talking about how a purchase price is spread out over a number of years. So to give you an example of that, let's say if someone buys a tractor. Let's say it's a $300,000 tractor. Yeah, tractors can be very expensive. Or combines, I guess in this case, sorry, using the wrong terminology. Let's say they buy a $300,000 combine, which is a form of farm equipment. They can go into the hundreds of thousands. The CRA doesn't let you write off that whole amount at once as business expense. They make you spread it out over time. Even though you've actually paid the money, you can't actually claim it as a business expense in 1 year. That business expense gets spread out over multiple years. Presumably so that, I'm guessing it has to be so that the CRA basically collects more tax money and you pay less taxes in future years, so it gives them basically an interest-free loan on future taxes. Am I right about that, Raj?
I think that's their goal, especially, yeah, with all of the COVID handouts, they're going to try and collect more tax money too. So yeah, absolutely.
Yeah,
that's the goal.
yeah.
Yeah.
So I've got the factors in here that you can consider under Kowalewicz. But those are a couple of examples because a lot of these factors are fairly vague, but it really comes down to, is the money actually there? Is there some kind of legitimate purpose for the money? Is someone saving up the money? Maybe they're saving up funds. Maybe the profits are because they know that next year they have to make a really big loan payment. So there's something called a balloon payment where there's a big payment due towards the end of a loan. And I've had that come up where, all right, sure, companies reporting profits, but there's this giant loan payment coming up, so we need the money for a legal obligation. And some of these other factors don't really actually result in much concrete. So there's factors like expansion of the business. Every business can say that they're expanding. I don't know if I've ever seen a court decision really ever hinge on that. Maybe it's out there. There are court decisions that have said that it's probably a good idea to keep a little bit of a float. So there's a court decision that dealt with the oil and gas sector, and it said, all right, well, looking at the history, this business has really only survived because in the good years it saved money, it was prudent, and that meant that it made it through the bad years. So we're not just going to say that all that income should be paid out because that wasn't the history during the relationship. So it gets complicated, and ultimately it's really up to the judge that you're in front of. Judges have different ideas about businesses, and so you can have the exact same facts against in front of different judges, and they might have completely different decisions. There's other factors that were also mentioned in that Chakowski and Howland decision. So I've listed those, but I don't think we need to go through each of those individually. There's other factors in Sweezy. And there's also been some comments about making sure that you don't kill the golden goose. Is if you set income at such a high amount that it's forcing funds to be depleted. If you're adding all kinds of things back to the point where it's just not profitable, then you risk that that there's no incentive to operate a business anymore. If too much money is being pulled out, if we're using too many arbitrary figures to try to inflate someone's business, it can kill off a source of funding for this family that they rely on. So there has to be incentive for someone to actually operate a business, and especially since businesses take on usually end up using a lot more hours of a business owner than if they were an employee. And involve a lot more risk. Has to be some kind of reward for all the risk and all the hours that go into there. But at the same time, we don't want to let people misuse businesses to avoid legitimate support obligations. So it's definitely balancing. We'll touch on it a little bit later, but it is possible to obtain expert reports to try to find out what someone's income should be. So those are called guideline income reports. So someone like Raj can put those together to implement each of these calculations into a report that makes a little bit more sense to a judge. There are some judges who've cautioned against relying too much on expert reports and spending money on them. But then there's so many judges who really prefer having a clear expert report that just says, I'm a financial expert, I'm a neutral, I've looked through everything, I've done these calculations, this is what I think this person's income should be.
It's easier that way.
Yeah, exactly.
Yeah.
And a lot of the time we're trying to make sense of something complex to a judge, especially most of the time, unless you're in a trial. And the vast majority of applications in family court aren't going to be a trial. They're going to be smaller chambers applications with very limited time. You're trying to make sense of a law to a judge in a very quick time. So an expert's report can definitely be helpful there. One thing that I want to note, though, is that in those guideline income reports, usually the expert adds back the entire amount of the pre-tax net income to show what it would be. And that is technically up to the court about whether it should be added back or not. Usually there isn't a full analysis about all these factors in the Chartered Business Valuers report. So just be cognizant about that, is that it's something that can be argued in court. And there are different standards used by different experts. So some of them even compare what are the short-term, what are the assets that are really easy to liquidate, like cash investments, and what debts are coming up right away, for example. So sometimes there's comparisons that can be done like that. All right, and we talked about how profits in a corporation can be added back into someone's income because they don't just automatically show up in someone's personal tax return unless they've actually declared a salary or dividends or withdrawn money another way. But there's also rules if someone is just self-employed or they're part of a partnership. So in those cases, there is no profit because it's not a separate entity. Corporation's a separate entity that can keep its own profit, has its own tax return. But if you're sole proprietorship, so if you're just an unincorporated business, you're just yourself, all of that profit automatically gets added. It just shows up in your income, your tax return. There is no separate profit. So there are rules to say, just like a business, maybe some of that money that shows up in my tax return as a sole proprietor or as part of a partnership, maybe that is money that's actually available. Maybe there was some kind of business purpose to it. Maybe the business income isn't accurate. So that can be argued. Fairly rarely ever comes up in court. I think a lot of people just aren't aware of these rules, probably including judges. So it's kind of the reverse. You're saying that someone's income should be lower rather than saying that someone's income should be added back. But it is possible to do that with sole proprietorships and with partnerships. There's also decisions that have said what shouldn't be taken into account. So a court shouldn't just increase someone's income because there's cash available, for example. Because maybe the cash is because they have a bunch of expenses due the next month. Maybe it's cyclical. Some businesses, they might only get billed, if they've only got a few clients, maybe they only get billed every couple months, and maybe a big bill is due right away. Or maybe they've got cash because they've sold off an asset from past earnings, and maybe it'd be double counting to claim both those past earnings and the cash that they have from liquidating it. But the Court of Appeal has said that lack of cash might be relevant. So if a business doesn't really have a lot of cash, if it's only got $1,000 in the bank account, and if someone is arguing that there should be a lot of income imputed to this business, maybe that's a red flag to say maybe there isn't all of this income, maybe there's something else going on. Also retained earnings. So retained earnings is essentially assets minus debts. So it's kind of like your equity. I'm oversimplifying it, but it's basically your equity in the business. So courts shouldn't look at that either. So just because a business has assets, we shouldn't increase someone's income for support purposes. But again, it can be a barometer of corporate health, as if a company has a whole pile of equity, just a huge amount, then maybe we don't have to be quite so worried about not adding in income because we're going to harm this company. But conversely, if a company has very little equity, it means that maybe they don't have a lot that they can sell if they run into financial trouble, if there's some kind of downturn or if something unexpected, like a pandemic, comes up.
Yeah, you got to plan for that.
Yeah. And the onus is on the person who owns or controls the business to show that there's legitimate business reasons to leave that pre-tax net income in. So that's very clear. It's up to the business owner to prove that and introduce that evidence. So most court applications where we're dealing with support are going to be just interim temporary applications that are going to be based off of affidavits, which is sworn documents where someone said, I swear that all these facts are true. And so in those documents, as a lawyer, you'd want to make sure you include all those facts, or whoever you are that is putting together the affidavit. Who knows who'll be watching this on YouTube? I spoke before about how we just have to make sure that we're not double counting dividends, because they show up both in pre-tax net income and someone's personal income tax. There's another rule for dividends. So it's a mandatory rule. And it says that there's something called a dividend gross up that has to be deducted from someone's income when we're calculating child or spouse support. And so it's called the dividend gross up. And what it is that that same dividend that you'll see in a corporation's financial statements, in someone's personal income tax return, when it says what dividend they received, it's a larger number than what was actually paid. So it's artificially inflated by the government. And it has to do with different tax rates. And I believe, because there's different types of there's different types of dividends, like eligible and ineligible dividends. There's different tax rates, depending on whether there's international income. So it's really to sort out all of that. And so that in certain situations that someone ends up getting taxed up a little bit higher, the government has made the dividend higher, depending on the type of dividend. So
it's also integration with that dividend tax credit, right? So yeah, you're right, though. That's exactly the mechanism they're dealing with.
Yeah, so it's just important to know that in someone's personal tax return, their dividend it looks higher than it actually is. So you have to subtract the difference, and that's what the dividend gross up is. The dividend gross up is that inflated amount. So if you look to the financial statements, sometimes it'll be the same amount. Financial statements aren't the best way to find it, just because there's different year ends for businesses or personal. So personally, our tax year end is December 31st. So we as individuals, it's always just a calendar year that we're trying to calculate income for. But for businesses, they can choose different year end. And some years aren't even 12 months, especially if there's been a change in control, or if it's a newer business, there's different rules. So it might not even be 12 months. So the dividend in someone's financial statements, let's say the corporate year end is June 30th. Let's say it was June 30th of 2020. Well, half of that corporate year end is in 2020, and then the other half is in 2019. So there could be dividends in either year. So the timing isn't correct. So instead, the best way is to look at to ask for someone for their T5 slip. So it's a slip that says what investment or dividend income is. and it'll actually say right on there what the actual dividend is. So that's the best way, unless you're lucky and you've just got a corporation that has December 31st year end, or just it looks pretty obvious that they only pay the dividend at the end of the year, maybe. But it has to be removed, so it's an error to miss that. Just make sure you're cognizant of that.
Yeah.
All right, and we'll be going through we'll have a separate class on tax issues in family law later on. I guess you're getting a little bit of an early introduction to this, because I think that class is at least a month later. But there's different types of taxes that the government taxes on. There's quite a lot of different types, really. But one of them is called capital gains tax. And to really boil it down in really basic terms, it's basically that if something goes up in value, then you get taxed on it when you sell it. Again, there's piles of exceptions and different adjustments, but that's basically what it is. A good way to remember it. And it's treated separately, and there's different child support rules because for some reason you're only taxed on half of the amount of that gain. And so for child support rules, they say, all right, well, if only half of the gain shows up in your tax return, we want to know the actual amount. So it might be that you might have to double that gain, or if there's loss, then we use the actual loss. Except there is also a rule that says that if it's a non-recurring capital loss or business investment loss, then maybe we don't add it back, especially if we're looking at ongoing income. And so hopefully this will make a little bit more sense too by the tax class. And I wouldn't put tax issues on the assignment. So don't worry, I won't do that to you.
That's totally unfair. Yeah.
Exactly. That'd be awful.
Yeah.
I'd be having nightmares just feeling so bad about what I did to the students.
Oh yeah, and they would hate you for it.
Yeah.
Yeah.
But the associates, I'll definitely make them deal with tax issues.
I don't think you're popular around the office. That's my sense, Ken.
So the idea, though, is that we're going into tax issues multiple times, because the more you hear something, the more it's going to make sense. So by the time you get out into practice, hopefully you'll be able to go back to these notes and figure that out. So again, same thing. If a gain is a non-recurring capital gain, if it's something that's probably not going to happen again, maybe we don't add it into someone's income. And there's even different factors the courts have set out about whether we should include a gain or not. And again, I'm going to skip some of these slides, but might run into some of these things in practice. If you look at the federal child support guidelines, you might see something called business investment losses. And there's a rule that says that they must be deducted. So there's a question about whether this means any kind of loss. So let's say if a business loses $100,000 in a year, but someone is still pulling out cash, and it's really their savings from past years, do they get to deduct that loss or not? Typically, if it's an incorporation, we ignore the loss in general. It might need to be taken into account if we're looking at past earnings, for example, and if it'd be double counting, if there's also arrears, if there's already been child support paid on the profits of the cash that's being pulled out. But the reason why I bring up this business investment losses is because technically that doesn't mean an ordinary loss. The federal child support guidelines say that for most of the sections, that we look at the Income Tax Act's definitions. And under the Income Tax Act, the business investment loss is a very specific type of loss. And it doesn't mean just an ordinary loss. So I've got the definition here under the Income Tax Act. And a business investment loss is a loss which results from dispositions of property, which are shares of the capital stock of a small business corporation or debts owing to a spouse by a Canadian-controlled private corporation that is a small business corporation. So very, very specific definition, and even that's a summary. So really a business investment loss is if someone sells shares for less than they paid, or if they're, I think the debt deduction means if someone basically has to write off a debt. Do you know if that's right, Raj?
Yeah, no, that's right. A debt or shares, yes.
Yeah. So it's a very specific definition. So don't be confused by that. If you see business investment loss in the child support guidelines, it doesn't mean just an ordinary loss. But that said, last time I looked, there weren't any court decisions that really discussed that specifically. Like I referred to decision Coleman and Bergeron that discussed business investment losses and even listed factors. And you can tell by reading it that it probably has this business investment loss definition in mind. But it doesn't really discuss the distinction between business investment losses and when a corporation is losing money. So brings us back to what happens if a business is just losing money. Does that get factored in? Because if the business is losing money, but you're still pulling out compensation, in a way you're relying on savings. You're not really relying on income that's coming in. So it's a little bit theoretical. And I think the idea is that generally we ignore ordinary losses, because if someone is pulling out money from a business, let's say if they have good years and bad years, but either way they always pull out 100,000, then why would we decrease child support if that's consistent money? If they find a way to make it, if they're finding a way to pull out money, why would we make what would make the kids suffer? Yeah. So generally we tend to ignore them. There are some situations where losses could come up though. So for example, if someone has an unincorporated business, if they're in a partnership, then if they're in a loss, if you look at their tax return, you'll see that there's losses. Sometimes people have rental losses. So technically those automatically show up in someone's income. So not the corporate losses, but personal losses. But even then there's court decisions that have said that we should sometimes ignore those losses. So for example, if someone loses money each year because really they've got a hobby, so maybe they've got a horse and they claim that the horse is in competitions, but they put in way more money than they're actually getting. That happens. So sometimes it's some kind of leisure choice. And so sometimes the court will ignore the loss if it's really just a loss that's supplementing a personal hobby. In guideline income reports, chartered business auditors usually show what happens either when we add the loss, subtract the loss or add in profit. A lot of that is so that we can compare multiple years. So especially if we're looking at arrears and we're trying to figure out our withdrawals from one year, really just profits from a previous year, or if there was losses, are we relying on previous year's profits now? When you're looking at multiple years, it definitely makes sense to look at, to sometimes take into account those losses, especially if it's what's being pulled out in subsequent years. Because even if the company makes a lot of money one year, maybe they pull it out as a dividend the next year, and that's what creates the loss.
So can you see an averaging as being appropriate in years of losses then for corporations, potentially?
Sometimes, yeah, I think it's really fact specific, but in some cases, yeah, it might make a heck of a lot of sense to just average out income and losses, especially if we're looking at the past. If we're looking at trying to calculate arrears, if we're looking at multiple years, that can definitely make sense. If we're trying to figure out what should ongoing income be if there's been fluctuations in the past, then yeah, averaging out those that profit and losses, I think, makes a lot of sense. Because I think legislators' concern is mostly that they just don't want If we just had a loss here that they don't want child support to be reduced to nothing,
Right.
even though people are still pulling out money.
Okay.
But if we're looking at something like arrears, for example, that's not as much of a concern anymore. We're not worried about children being destitute
Right.
necessarily when we're speaking about arrears.
Right.
All right. And so there have been some decisions that talk about double counting. So if you can't double count both dividends and past profits. So there's one decision, I believe what happened was that there was past profits in a previous year. Child support was calculated, I think there was arrears calculated based off of that amount. But then also in a later year when someone pulled out those past profits as a dividend, child support was also awarded on that amount. And so this was, I believe this was the Court of Appeal on VOE and LLE. And this was actually someone, the appellant was a self-represented litigant who didn't have a lawyer, and actually convinced the courts that that was improper for the lower court to have done that, to double count dividends derived from past profits. So a huge win for someone without a lawyer. That definitely happens, because I think that this was the first time that the Alberta Court of Appeal really recognized that double counting issue. It's not an easy case. It's not an easy decision to quote, though, because they don't say that very clearly. It's not the most explicit decision, but there is that decision out there. And there have been McCarty and McCarty. It's a decision of, it's a Court of Queen's Bench decision of Justice Renke, who was the vice dean at the University of Alberta Faculty of Law. So it's a very academic decision, which in my mind is a little bit of a critique on how quickly some courts have gone to just artificially increase income in the past. All right. So some of these decisions are just summarizing what I've said already.
And is it worth addressing double dipping, or perhaps later, or at all?
Yeah, we go over that in the spousal support class.
Okay. Yeah. Okay. Sounds good.
Yeah, definitely. So that'll be a separate class. But yeah,
Okay.
What Raj is referring to, I can't remember the timeline, but by the time students read this video, they might have already seen the double dipping class. But it might not just be students who are watching this recording. So what Raj is referring to is that if we already divide an asset, then for spousal support purposes, it might not be fair to say someone gets half of that asset and half of the income coming out of that asset. Because especially if we're valuing that asset based off of how much money it can generate, then if someone gets half the value of business based off of how much money it can generate and half the income, they're basically getting that full asset. So that happens with businesses. Double dipping comes up with pensions, investments. So it's definitely a spousal support issue to be aware of. And anyone in my class, hopefully we've already discussed that. We've got to have a guest lawyer for that class, Laura Breyer from Breyer and McKay.
Oh, okay, good.
All right. So I spoke about earlier about how courts can also add back expenses. So I think I gave the example of a cell phone before. If someone deducts their entire cell phone, and they just have the one cell phone for both personal and business purposes, maybe a court should add some of that back. So the way that the law is set up is the guidelines say that court can impute income where the spouse unreasonably deducts expenses from income. So we're talking about things like cell phones, we're talking about vehicle expenses, home office deductions, sometimes different types of insurance, travel, meals, entertainment, promotion, alcohol. I had a situation where this family put their house into a business, and they thought that they could just deduct basically any kind of expense, even their living expenses. So you'd go through their financial records, and they were even deducting like hundreds of dollars at the butcher shop, even though that had nothing to do with the business. And so that's So there's all kinds of things that a court could add back in if they've been deducted, but they aren't entirely for business purposes. So the court doesn't have to follow what the Income Tax Act rules are, which is a bonus for those of us who are going to be practicing family law, because it means that you don't necessarily need to know all the income tax rules about what can be deducted. It might be a good guideline.
Yes.
And in that situation, the couple would put their house into the business. It actually ended up burning them. As they had some audits, but this year I didn't notice it. But later on, when they had to pull out the house out of the corporation, usually your house is exempt from taxes, from capital gains tax, your principal residence. There's limits, but for this couple, only individuals get that exemption. But the house being in a corporation meant that they didn't get that exemption, so even pulling out the house to transfer it to one of the spouses when they separated meant that we had to account for all the taxes that were due. So they got burned, they had to pay a bunch of taxes, and
yikes.
So got a little bit of karma.
Yeah.
All right. So the Court of Appeal has said that it's the person who controls the business or owns it to prove that the expenses are legitimate, really. They have to disclose whether there's a personal component or whether there isn't, and the extent of that personal component. So that decision was Cunningham and Saveni. And so sometimes we'll hear the word Cunningham disclosure. So that's a form that someone has filled out to say, here are my expenses. This is the proportion that may have a personal component. It's disclosing those amounts.
That's awesome.
And something to be aware of is, let's go back to that cell phone expense. Let's say if someone was deducting like $500 a year for their cell phone, and that might show up in their corporate financial statements. And so, if they've deducted that $500, it doesn't necessarily mean that's the entire amount of the expense. So it's worth checking in with their accountant, or if they have records, because maybe their total cell phone expense was $1,000 and they only claimed $500. So there might already be some kind of proportion that's allocated. So it's definitely worth checking with the accountant. Some accountants even have forms where they ask people to fill out like how much do you spend on your cell phone, your vehicle, fuel, what kind of proportions personal. Sometimes accountants already have those forms even, but if not, the accountant can probably give you an idea of how much is actually deducted. So just make sure that you're not double counting, because if the accountant's already deducted a portion, but then you also add a portion back into someone's income, then you're double counting.
Yeah, for sure.
There's also a question too of whether we should gross up those expenses for taxes. So let's go back to that example. Let's say it was $500 a year for cell phone. Let's just say that was the entire expense, that they deducted the entire expense. They didn't just claim a portion of it. And let's say we found out that 10% of the cell phone is used personally. So we want to add back in $50. So the question is, if we add in that $50, if we're trying to compare an expense to an employee has to pay taxes when they pay for things. Like maybe a proportion of the cell phone isn't the best example. So let's say if you buy a liter of gas, let's say a court adds the cost of a liter of gas back into someone's income. When an employee, if we're trying to compare apples to apples, an employee would also be paying taxes on that amount. For them to spend money on a liter of gas, they would have to earn the cost of that liter of gas plus the taxes. So there are some people who think that there should be a tax gross up if we're going to add expenses back. It's very debatable about whether that happens or not. So chartered business valuator reports tend to just automatically add those expenses back. Because I think the theory is that if people are coming to a chartered business valuer, they expect the chartered business valuer to do tax calculations for them. Yeah. And so a lot of decisions end up just adopting whatever the expert's report is, because I would think that a lot of family law lawyers probably don't know the intricacies quite as well as we all do now that we've gone through this. And so it doesn't tend to be argued very often in court whether this should be added back or not. And in most situations, there isn't an expert report. And so when amounts are added back, same thing. Conversely, people aren't arguing whether there should be a tax gross up or not.
And so, Ken, this area is not dealt with in the federal child support guidelines, is it either? There's no direction there. So it's a very gray area then, is it fair to say?
Yeah, exactly. Like there is a portion of the guidelines that says that income can be imputed where someone is basically paying an inadequate amount of taxes, or lower amount. I forget the exact wording, but I think that's the basis to try to say that there should be a gross up.
I see.
But the argument against is that if there should be a gross up, it should be a lot more explicit. That there isn't explicit to say that when there's because there is a portion that talks about adding back unreasonable expenses, but it doesn't say add back those unreasonable expenses plus a tax gross up.
Right.
And there's all kinds of arguments that could be made on either side. So let's say, so arguments against a gross up. So there has been at least one court decision that just refused a gross up. They considered it specifically, and really the arguments against it is that it's not explicit. If we want people to start doing tax calculations, we're overcomplicating child support. Is that child support is supposed to be calculated? It's supposed to be very simple. It's supposed to be that you calculate it quickly so that you can move on with your lives, so that you're not fighting every single year about child support, since it gets recalculated each year. And also, let's say if someone's only business expense was buying a liter of gas, and let's say that was all of their revenues in the year, their only revenue was used to buy a liter of gas, and then we add that back to their income. Well, if we add it back plus a gross up, we're actually adding back more than they actually received from the company. So we're making someone pay taxes on more than they actually received. And child support is already very contentious. If we're arbitrarily adding money back, if we're looking for ways to maximize the amount of child support, one, it can create a lot of animosity in the separation. Again, there's that concern about killing the golden goose. We don't, and just because someone saved money by not paying taxes, we tend not to impute someone's income because they save money other ways. Like if someone didn't pay their traffic ticket, we wouldn't say, oh, well, you didn't pay your traffic ticket, so we're going to add that money back because now that's money that you have.
Well, Ken, this can be a very material adjustment, particularly when we talk about even non-arm's length salaries add back, right? And if you're going to gross up for income taxes, so this is a significant issue. Can be a significant issue. Yeah,
and at least for tax, like at least for salaries, they do pay taxes off of what they have afterwards. So for salary, I probably wouldn't gross them up.
Okay.
But if it's an amount that someone would normally have to pay taxes on that they haven't had to because they claimed it as a business expense, then it can become an issue. So there's definitely arguments. There's definitely a lot of arguments on both sides, whether we're trying to compare someone to an employee or whether we're just going too far, that there has to be a limit.
Perhaps a good solution is to have the expert do a with and without perhaps calculation and let the trier of fact decide then.
Yeah, exactly. And that is an option too, is that I don't think that there's one way to do a guideline income report. And so you have the ability, if you're hiring an expert, to say, can you show me multiple scenarios? Show me what it looks like if we're adding back the expenses, if we're not, if we're adding profit back in, if we're not. So you can ask for those reports to be customized, or for them to be entirely in your favor, I guess, as long as it's independent and accurate. Because really, you're just asking for a scenario to be shown. All right. There are a few specific expenses that are a little bit more interesting, where there have been court decisions about. So one of those expenses is what we spoke about earlier, amortization. That also gets referred to as depreciation, capital cost allowance. So that's where if someone, basically if someone buys an asset, the CRA makes them spread that out over multiple years. So there's special rules about this, because let's say if someone bought an asset last year, but there's still, the cost of that is still coming out of their income. And if it's a one-time purchase, if they're not saving up, if it's not something that they intend to buy in the future, then if we're only calculating ongoing support, then what does it matter that they bought something in the past? So maybe we add back some of that amortization. So there are court decisions that have spoken about different tests and whether there's an intent to replace, or is money being set aside, or was the asset even for a business purpose? Maybe someone bought a quad that's mostly personal. Especially farms, you see equipment and vehicles in there all the time. Something like a quad, maybe they use it to pick up rocks out of the field once a year, or to check their field. But maybe the kids also use it just for recreational purposes. So maybe you have to figure out what a proper proportion is, or if there's maybe there's 4 quads and they would have only needed 1 for business, because sometimes maybe it's not fair to split up an asset like that. Because something like a quad, if you need 1 for business, maybe you shouldn't add back expenses for that 1 quad, because it's not like it's not like you can buy a portion of a quad for business, and if it's just sitting there, why not use it for personal purposes? So we get into a lot of ethical debates when it comes to this, and it's very, very fact specific, which is unfortunate, because it definitely complicates support disputes. So, like I said, I included a few different expenses there. I did do a study a couple of years ago in 2018, where I went through absolutely every Alberta court decision that talked about either amortization, depreciation, or capital cost allowance. Went through every reported decision that was on Canley, anyways. Actually, I might have even looked at Westlaw, but either way, I had a look, and I saw a few things, a few trends. So one was that amortization seemed to be less likely to be added back, where a court specifically noted that there was full disclosure, the documents were exchanged, and a lot of information was exchanged. Courts like that, so there was a decision where they didn't add anything back. But it depends on the facts, because if someone fully discloses and they fully disclose a lot of personal use, then it would be appropriate to add some back. Conversely, where courts noted that there was a lack of adequate financial disclosure, they sometimes added back, a couple times even that entire amount of amortization. So basically, you didn't give me enough information, so I'm just going to add the whole expense back. You should have given me more information. You should have provided an adequate amount. And we'll talk about what you're expected to provide, disclose, both later in this class and in a separate class where we're going to touch on disclosure. And sometimes if courts noted lack of disclosure, sometimes they just added in larger portions. If we're talking about an asset that's also the owner's personal vehicle, usually courts added back either somewhere between half to all of the amount back into someone's income. They didn't let them deduct the entire amount in someone's personal vehicle. And of the remaining 27 decisions, 10 of them made no adjustment, didn't add anything back. 4 of them did add it back. So 4 of them added everything back, all the amortization. 8 of them added about half, and on average, they added back about 35%. So all over the place. That's just to tell you it's all over the place. Depends a little bit on the facts, but if we're not clear on the facts, then at least that's a little bit of a guideline that each side maybe faces a little bit of risk about what might happen in court, like a lot of issues.
Ken, one potential treatment might be that we as valuators will try and assist with is to add back the amortization and deduct what we call sustaining capital replacement, the amount to invest that needs to be invested in assets. And I think you kind of addressed that a little bit earlier, but yeah.
Yeah, that would definitely be a good approach. Yeah. I don't think I've done that before.
Oh, okay. Yeah. Yeah. You had a little bit of reference to kind of what needs to be invested in assets, right? So that's the concept. So similar to your earlier concept. Yeah.
Yeah. Well, that's a good idea. I'll have to remember to ask for that in the future, because the more information that we can get to a judge for them to see that, better picture they can get. Yeah, that makes a lot of sense. All right. Already spoke about how the portion of a loan repayment that isn't interest doesn't necessarily appear in someone's financial statements. So maybe we should, but usually we're looking at that when it comes to net income, because there isn't really a way to deduct further expenses under the child support guidelines. But it's something that could be taken into account when we're deciding how much pre-tax net income to add back. All right. Another type of expense, Raj mentioned it earlier, is that if someone is hired, maybe they've hired their new spouse as part of the company, maybe they've hired the children, maybe they've hired some other family or friends. Sometimes that's not legitimate. Sometimes it is. And so I'll give you an example. There's two decisions I'm able to speak freely about because I have consent forms filled out by the clients that I could speak about the decisions in seminars, including a decision that I took on. I took on the appeal of it just because it was an interesting decision. I contacted the lawyer on the lower level to take the file, and that decision was called Sweezy and Sweezy. We'll come back to that later. But at the before I was involved, the facts were that someone had purchased a truck for a trucking business after the separation, and they'd started this corporation. Their new partner, I think, owned half of the corporation, and so the question was whether dividend payments, whether profits paid to that new partner should be added back or not, or whether salaries paid back to that new partner, because I believe that there was a salary that was claimed. This was a few years ago. And so you would think companies started after the separation. It was a trucking business, and the spouse that was part of the litigation was always a trucker before. So the initial thought, I'm sure, of everyone was, should we just automatically have this new partner's compensation back in? Is this just a way to shield the spouse from paying extra support by letting them split income? And so in a lot of situations, the answer is yes, maybe we should be adding in that new spouse's income. But in this situation, what it was that the new partner had put up her home as collateral for the loan to acquire the truck. She regularly helped out with the trucking business. She was involved in the financial records. But just even by putting up her house as collateral meant that she was very directly invested in this company and had shared part of the risk. So it probably was legitimate to pay out some income to her. So I don't remember there being any kind of big adjustment for income to the new partner. So various fact specific again. But let's go into law of what's expected and how a court decides an issue like that. So what the child support guidelines say is that it's the person who owns or controls the business who has the onus to prove that the compensation was reasonable in the circumstances. And our court of appeals said that person both has to provide the evidence and has to convince the court that it was reasonable. So you have to make sure that, again, your sworn evidence, your affidavit, lists out all the facts. Ideally, hopefully there's hours of logs of hours that family member or friend is put into the business. That would be very helpful. Or to know, do they have another full-time job? Is this their only job? Is it a full-time job? What kind of hours do they regularly work? Because it's pretty rare in a small business that's all family, probably not going to have logs of hours. That'd be very rare. So sometimes you have to be creative and look for those other indicia. All right. There are courts that have even suggested that if someone can't prove that, the entire amount has to be added back. It's definitely a harsh result, though, is in a lot of situations, maybe only some of it should be added back. But there are those decisions out there. I don't know if they'll necessarily be followed. You never know with Court of Queen's Bench decisions whether they're going to be followed in other decisions or not. Sometimes even Court of Appeal decisions aren't always followed. Another issue is control of business. So I keep saying if someone owns or controls business. So that's because in some situations, maybe someone doesn't even have shares in the business, but we still attribute income to them for support purposes. So again, another really good example is I had a situation where after the separation, someone claimed that they sold the business to their mother, and we went to a questioning. And so that's where each lawyer gets to ask the other client questions, and it's typed up by a court reporter. And when we went to questioning, we found out that the mother hadn't actually paid for anything. The really shocking discovery was that at the time that the business was supposedly sold to her, she was living in an assisted living facility with dementia. So supposedly she had bought the business then, and pretty much found out that she didn't really have any involvement, but might have signed like some kind of annual return or maybe something for the accountant, he thought, but otherwise wasn't involved in discussing with the accountant, wasn't really involved in the tax process, wasn't really involved in the incorporation process, wasn't involved in any of the day-to-day business of this corporation. So once we had that transcript, it was very easy to show later judges that this really was someone's business, that there wasn't really a legitimate purpose for their mother suddenly owning the business. It was clearly a plot to try to minimize support and shield the business from the claims of their former spouse. And for the record, I didn't act for the business owner on that one.
That's a good disclaimer. Yeah.
Yeah. Sometimes you do have to act for the person who's done some improper things, and then you're just on damage control, but not that one.
Yeah. That's good. That's good. You're clean.
Yeah, that one. On that one.
On that one.
But well, I mean, it brings up a lot of ethical discussions, though, because we also can't, as lawyers, we can't mislead the court, we can't mislead other lawyers, and we can't let our client mislead the court or other lawyers. So in some of these situations, when you find out that there has been a sham, then your obligation is to say either the client comes clean or you have to get off the file.
Yeah.
So that definitely happens. So basically, all the rules that we've spoken to about attributing income still apply to a spouse who has control of the business, even if they don't directly own it. So our Court of Appeal said that. It's Court of Appeal. So it is the law, and it's especially if the structure has been designed in part to shelter or has the effect of sheltering the spouse from liability for support. So you can see that quote came from the Sweezy decision that I mentioned I was part of. I wasn't part of that decision, I was part of the appeal. And they ended up giving us an offer that we couldn't refuse, I think a week before the hearing. So we didn't actually get an appeal decision on that. It got settled, which was good. And same thing is you can enforce, well, not the same thing, to a greater extent, you can even enforce arrears against a company controlled by a debtor. So our Court of Appeal allowed someone to collect arrears for support from a business that wasn't actually owned by the spouse. So interesting way to pierce the corporate veil if you've taken corporate law by now. But there has to be evidence of that control. So you definitely need to build the evidence. So for example, like I did going to questioning. And you can even, you could try to get financial disclosure from that company. There's a process to do that through Rule 5.13, which lets you get documentation from a third party. So you can build up that evidence. There's ways to do that. But that's third parties in a nutshell. Next one is financial disclosure. So we'll deal with what needs to be disclosed in the separation and other class. Because really, before you can negotiate anything, each side has to have sufficient information. You can't negotiate things like support when you don't actually know what the facts are. So there's different processes, for example, to get the very basics like corporations' financial statements and income tax returns, and sometimes even bank account statements, at least the personal ones for up to 6 months. And so there's a really simplified process to get all of that. But there's different rules that apply to a business. So our Court of Appeals said a business can't just throw a bunch of disorganized receipts at someone or say, talk to my accountant. There's specific expectations that are on businesses. So the simplified process to get the basic information I mentioned was the notice to disclose process. So that's where you can get things like income tax returns. And there's all kinds of things. I've got them listed in here. So for business, you get the financial statements. So it shows their total of their revenues and their expenses, what their net income is, the pre-tax net income. Shows you what kind of assets and what kind of debts are in the business. So you can get that. You can get last 12 months of shareholder loan transactions. If someone's borrowed money or lent money to the corporation, you're supposed to provide records of that. If they're kept, they're not always recent. And also, you're expected to disclose any kind of compensation or benefits to the shareholder or any kind of non-arm's length person. So payments or benefits to family and friends. And when we talk about benefits, we're talking about things like maybe the shareholder has the whole family on a cell phone plan. And so everyone is getting a personal benefit from the cell phone expense. Have to disclose that. And there's a couple other lots of different types of disclosure that need to be provided. So when I say disclosing those benefits or payments to the shareholder or friends or family, this is the more specific section that we're talking about, section 21 of the guidelines. And as part of that streamlined process, the notice to disclose application. So when we talk about those personal benefits, compensation, and expenses that may have a personal component, the main decision that we're looking at right now is called Cunningham and Saveni. And I wouldn't be surprised if in the future we have some follow-up decisions that clarify this a little bit from the Court of Appeal. But right now, what it says is that it's up to that person who owns or controls the business to prove that the expenses are reasonably deducted. And you have to do that by providing some kind of information, some kind of statement or form that has enough information to basically let a court figure out just by reading the statement whether those expenses are reasonable or not. So there has to be enough information to make sense. And it doesn't mean that you have to provide unlimited information, because in practice you'll find that there's a lot of files where the other side is just constantly asking for more and more information. Sometimes it's a stall tactic. Sometimes sometimes it's because maybe if this is resolved, they would owe you money. So by constantly asking, maybe it slows things down. Maybe they're convinced that there's something improper going on, and so they just keep constantly asking for more records and not finding anything, and they're just looking for something to validate. So there is an extent, and so the court has recognized that at the same time. So for example, I had a situation where we were fighting about doorknobs. There was 2 receipts for a doorknob on a rental unit, and this never got resolved. The spouse who didn't own the business, I think, still thinks it was illegitimate. And my client said that the expense was because he found out the doorknob was open on rental unit. It was a really small town, so he goes to a shop to buy a new doorknob. He goes to repair it, and he finds out that the tenant had already bought a replacement doorknob from the same shop, so he ends up reimbursing the tenant. So the other spouse thought that was double counting. He said that was the story. Who knows? Difficult. I guess we could have gotten the receipt from the tenant, but yeah, sometimes you end up fighting about that much detail, but hopefully not, considering the amount of money that people are paying you.
Yeah, it's not cost efficient.
Yeah, exactly.
Ken, do you have does your office have forms to help with your clients who have to do the Cunningham disclosure, or?
Yeah, so we do have a form. It's going to be a handout in the class. So we call it a business expense statement, and it's based off of that Sweezy decision that I was part of. Because the lower court decision that I wasn't part of, the judge, Justice Youngworth, had actually provided basically an example of how that information could be set out.
Okay.
So I think I've got that in a couple of slides down of an example of how that could be done. I'm also going to be working on a new form because I find that people are really struggling to figure out how to fill out that form, especially people who don't. Well, even most accountants haven't dealt with that form.
Yeah.
It doesn't get brought up that often. So I'm trying to work on a new form, but there are different ways where we've tried to do this, because it's one thing for the Court of Appeal to say that business owners have to prove that all of their expenses are reasonable. It's another thing, how do you actually do that? Because the Court of Appeal didn't really tell us.
yeah, it's a practical problem for sure.
Yeah. And also the amount of detail that you have to go into depends on how much control you have. So if you only own like 1% of shares, then maybe a letter from management just saying what kind of personal benefits the person actually got, what's their compensation package. Maybe that's enough in that kind of situation. But usually a letter from the accountant isn't sufficient, because we get lots of letters from accountants that just say all the expenses are reasonable and comply with the Income Tax Act. But that's not the analysis that we're trying to do. So courts have said that's not good enough. So this is what I mentioned Justice Youngworth had put together in that decision, Sweezy and Sweezy. So it's for each type of expense, each category, you have to set out the nature of the payment or the expense, brief explanation, how it's calculated, why it was reasonable, whether it resulted in some kind of personal benefit, what kind of portion formed the personal benefit, how it was calculated, description of services performed by a person, and also suggests that documentation to support all this should be provided. So I took on the appeal because I thought that this was too much and I didn't want to do this on all my files. Like some of it actually makes perfect sense. So like paragraph 1 in the subparts, I actually thought was a great idea. I didn't like so much number 2 to provide all the supporting documentation. Let's say if you've got a business where they've got like 1,000 little receipts, you can't feed that into a photocopier easily. Someone would actually have to sit there and scan in every separate receipt. That could take hundreds of hours in some businesses. So, and that part isn't, like the legislation definitely establishes that people have to provide some kind of statement to show the personal proportion. But I don't think that the legislation encompasses a requirement to provide all of the supporting documentation. A court could order it. Someone could apply to obtain that information through the court process. But sometimes we'd be talking about the cost. Like if it's going to take the accountant more time to actually copy all of that, maybe the person requesting it should pay the costs initially. And then maybe if they find something illegitimate, then maybe they get some of those costs back from the other party. Or maybe arrange for some kind of viewing where the person can just go to the accountant's office, go through the documents under supervision, so that we know that nothing's being taken. Or maybe we pay for their expert to do that. So I've done that before, where we have a forensic accountant is given license through a court order to go through all the records to whatever extent they want. And And if a category of expenses doesn't have any kind of personal component, Sweezy has said that you can say all payments in a particular category were for corporate purposes only, and no personal benefit was derived. Same thing, if you control a business, you still have to disclose all of this, even if you don't actually own the shares. Oh, sorry, my computer froze there for about 10 seconds.
Oh, I was wondering, yes.
I don't know if my screen froze there too. But we're not
No,
re-recording.
I think screen.
We're going ahead.
Okay.
All right, Raj, we have to redo the last hour.
Yeah, that's right. That's right. This is the Zoom generation of presentation. These things happen. Got to be used to it.
Yeah. Okay. And so what a subsequent court has said is that if someone actually reasonably complies with this, if they put a decent amount of effort into disclosing their personal benefits, and if the other side isn't able to disprove any of it, really the court should be relying on this. Courts shouldn't just be relying on speculation. Because there's, I think it's fairly well known that especially for some judges, a lot of the time they tend to order something temporary that's right in the middle. And so you see some lawyers who go in there and just make extreme suggestions saying, well, I don't know about any of these expenses in this business, so we shouldn't recognize any of the expenses. Let's just set someone's income as their total revenue. And they probably get cash too, so let's add 100,000 back to their income. So I think they're sure their tax return says their income's 100,000, but I want to say it's $1 million. And the other side is saying 100,000, and then the court says, well, I have no idea, so I'm just going to go with 400,000. So I think this statement was meant to say, look, if someone goes through the effort, if they can say, look, I put out like a 5-page statement on this, we wrote it all out in detail, then the court shouldn't just be going off of speculation, because it's creating a lot of hardship to say that someone's income, sometimes in court we're like doubling, quadrupling many times someone's actual income or what a reasonable income is, just because wild allegations are being made. So at least there's one court decision that says you shouldn't do that. So whether all supporting documentation actually needs to be disclosed, Sweezy technically recommends it. It doesn't say that it's necessary, but it is recommended in Sweezy. Again, practically that's very difficult, especially for larger businesses. And I don't see the legal basis unless a court has made a separate order requiring it. And I do like being open and honest on files to an extent. Is a lot of people just automatically have distrust about businesses because they've heard these wild stories, and I think people want to be the one who has a file that has these really interesting things going on, and they want to be the one to find the fraud, or the spouse is just naturally distrustful because they've separated and they're not around anymore, so they're really worried about what's happening and they're speculating. So I like being just open, just provide everything, and then contrast that with a lot of files where people don't provide information, and hopefully we look really honest to that lawyer, so that lawyer can say, look, these people are being honest and transparent. They're providing what's required. I just don't see the fraud that you're looking for, client. So there is a lot of benefit to being open and honest. But again, there's an extent, as if it's going to cost your client thousands of dollars to have a bookkeeper spend a week photocopying things. For a lot of small businesses, that's just not feasible. So there's been other court decisions of Cunningham to try to say what's required. So some courts have said that Sweezy breakdown might be enough. There's a decision of Justice Gresser, which was Zadib and Zadib, which I'm sure I'm mispronouncing. But in there was an example that said just receipts and invoices will be produced if requested. So in class on Twen, you'll see that I've handed out my business expense statement form. If I put together that new one, I'll put it up on Twen too, so you can see it. So you know what to fill out, because it's not a court form that's available on the court's website. So it's based off of that Sweezy decision. All right. So it's important to know what happens when disclosure isn't adequate, when there isn't enough provided. So when it comes to child support, a court can just order disclosure. Court orders requiring you to provide disclosure look bad and often get cited by later judges or get used as examples of people missing information. Technically, someone can be held in contempt or their claim can be struck. Sometimes cost penalties, penalties at the end if you lose could be even higher. Sometimes an adverse inference can be drawn. So we assume that someone is hiding information and we assume that it's pretty bad and that's why they're hiding it. So we just use a higher income for them. But even if someone hasn't provided enough information, in practice, I've found that there's some cases that talk about Cunningham, and they really don't add as much back as you think. So in one, a business owner had suggested that maybe 15 to 20% of his expenses were personal, didn't really provide a lot of information. Court just added 20% back based off their word, which I'm sure the other spouse wasn't happy about. And there's some decisions that just don't adjust anything. There's one that was upheld by the Court of Appeal that didn't make any adjustment because there'd been extensive financial records. Raj, did you want to talk about some of these other documents that are sometimes helpful to track down?
Yeah, absolutely. So you've mentioned here on the slide the general ledgers. So general ledger is a great document to obtain. It details all of the transactions going through a business, the date of the transaction, the account that it's been applied to, and the amount. So sometimes there isn't enough detail within the general ledger, but it's a good starting point, certainly. And you may need some supporting documents such as invoices or receipts if you require. This is helpful for the guideline income determination, particularly in relation to personal benefits. So you mentioned before, Ken, about reviewing accounts such as advertising, travel, meals, where you may have some personal common accounts where you may have some personal benefits. So that's where we like to obtain the general ledger. And then the second benefit is if you're getting a valuation report done on a business. So certainly there's earnings adjustments within the valuation that can be made by the expert. And if they have the general ledger detail, it may provide them with sufficient information to make those adjustments. So that's my comments on general ledger. So I'll be on to the next slide here. Talking about amortization schedules here. So also called property, plant and equipment, or we may call it a fixed asset continuity schedule. So it's got a few different names. Helpful to obtain these, again, with regards to determination of guideline income, because as I'd mentioned earlier when we talked about whether amortization should be added back, this gives us the detail of what amortization has been applied to and whether we should add some or all of it back and replace it with that concept of sustaining capital replacement, which I refer to as, which is commonly referred to as the amount that has to be invested in assets annually to keep the business going. So amortization is a mathematical deduction based on the Income Tax Act commonly, and so you may want to replace that with the actual amount needed to be invested in assets, and this allows us to do that. The other significant benefit of obtaining this property schedule or fixed asset schedule is to allow, again, if you're getting an evaluation report, to allow your expert to adjust the net book value or accounting value of assets to their fair market value. And we may need another expert involved, such as an appraiser, to do that. But this schedule allows us to assess whether that should be considered or whether we should have management estimates if that's reasonable and there's a desire to be cost effective, or another expert is hired depending on materiality and sensitivity to the values. So those are my comments on amortization. Other documents to obtain. So here we talk about obtaining loan documents, and Ken, you had addressed before the amortization. These are also called amortization schedules, but this is a loan amortization where we have a split out between the principal and interest payments or portions of a loan. So that's very helpful for us. And credit card statements and adjusting journal entries. So at times we like to get the credit card statements because within the general ledger, we do not have sufficient details. So the whole credit card statement may be entered as a one-line entry, and we may need to drill down into the components of that credit card payment as to what was included, again, as an example for personal benefits. So we like to obtain those. The adjusting journal entries, we like to see those. Those are applied by the accountant when they're doing the year-end financial statement. And again, it gives us, allows us to determine whether there's been an adjustment, for example, for personal expenses. So that's where we would see where an accountant at year end has gone through potentially the cell phone expenses or the vehicle expenses and has adjusted for that personal portion for the owner. And then we know whether we need to do that again or not, or whether that would be double counting. So those are my comments on the other helpful items that we like to obtain as accountants.
Thanks, Raj. I'll take it over from here.
Okay.
And who knows, maybe if I have some extra time, maybe I'll CGI some special effects. Do you want to be riding a dolphin or a bear? Or?
I like dolphins, actually, so that'll be awesome. Let's try that.
We'll see if I have the time. Probably not.
I've never done it in person, so I don't know when else I'm going to do it. Might as well be now. So.
All right. So like I said earlier, we'll talk about additional disclosure rules. We'll also go over a decision called Chateaubert, which talks about specific disclosure in terms of providing enough information for someone to be able to value a business. So I just wanted to go through a little bit of disclosure when it came to income. So that's what we were focusing on there. So let's talk about experts. So I'll talk about experts a little bit generally, give you some law, and then we'll let Raj take over to talk about some specific types of reports that he tends to prepare for family law situations. So if you've taken your evidence class, you might know that opinion evidence can only be tendered by a properly qualified expert. So people shouldn't be speculating about the value of the business. Usually, unless we have enough information about what the assets are worth. If we're just going off the assets in the financial statement, maybe that's enough. Maybe that's enough. But most businesses, or maybe not most businesses, but larger businesses tend to be worth more than their assets in general. And Raj can speak about that a little bit more, but to give you a concrete example, let's take like a McDonald's franchise. A McDonald's franchise isn't worth just what the business is worth, or sorry, what the building is worth. It's not worth just the building, or even if you add in all the inventory and the equipment. It's worth more than that, because as a unit, how everything's organized, it can bring in a lot more money than that. So to be able to show the proper value of the business, usually we need to get a properly qualified expert. So we're talking about an expert who has sufficient training. A lot of the time we end up, people try to use like financial advisors or maybe just accountants who don't have that valuation training, try to use rule of thumb valuations. They're usually dead wrong from what I've seen. You definitely want to get a chartered business advisor like Raj to be able to do those types of calculations. But that's the idea, is we're trying to find someone who's qualified, who has the experience or some kind of maybe academic training to be able to render a proper opinion on a subject. And their report has to be based off of actual evidence. So if the evidence turns out to be different than what their assumptions are, so let's say if we find out that something in a financial statement was dead wrong, for example, or maybe there was some kind of payment to a third party that wasn't taken into account, then it might mean that expert's report is wrong. So it means making sure that you get enough evidence to your expert. And same thing, there was a court decision last year that said that you should have an expert to demonstrate that there's an error in a financial statement. Speculation by a lawyer isn't enough. So again, a lawyer testifying on behalf of the client isn't necessarily an expert, especially if you're at trial. I think for temporary smaller decisions, a judge has to just decide what they think is appropriate temporarily. But if you're a trial, you definitely have to consider whether you're getting an expert. And even the Law Society has said that lawyers have to recognize when maybe they're not competent. So there's a lot of lawyers who've heard that, for example, to find out the value of a business, you should triple the income, which Raj can tell you pretty soon is definitely not accurate, even if it's a rule of thumb that, or even if it's kind of based off of an indirect rule of thumb that sometimes accountants use just for tax organizations. So lawyers shouldn't be doing that, and they should get the client's instructions, and they should be consulting others when appropriate. Some of it's going to depend on client resources. There's a lot of clients who just don't have the money for evaluation. So sometimes you do have to try to help them guess. Just be clear, get that in writing, and make sure it's their instructions that they don't want to hire an expert. All right. Raj, do you want to take over again?
Sure, yeah. So lots of different professional designations out there. I think the Chartered Business Valuator, which is what I am, and a lot of my colleagues, that's probably the most recognized, I think, in the family law area for valuation and for guideline income determination here. At times, you'll need to access forensic accountants. Particularly where you're trying to the financial statement information you feel has some hidden expenses that have either a personal benefit or what have you. So that's when you look at forensic accountants. And then certainly those with tax training or tax lawyers can help with even regards to the settlement. In fact, in regards to how best to settle the property. And then there's all sorts of other accountants, obviously, those who are CPAs, accountants who have audit background and training, and often the accountants themselves are engaged to, meaning the accountant that prepares the year-end financial statement for the corporation, very commonly engaged by the business owner to perform some of these calculations. And I think it's fair to just have a little bit of caution with using those people or financial planners or consultants, because they may not have training to regularly do family law specific calculations such as guideline income, which are very specific, right? So, but otherwise you certainly have a choice of professionals, and cost is obviously a consideration here too. So,
and I agree wholeheartedly. I've definitely seen a lot of situations where basically reports or opinions or even letters just drafted up by someone without their training creates a lot of harm, because if they do it and then the client sees like a number that's just not realistic at all, well, the client believes that number, even if there's another expert. So there's been a lot of bad situations just by getting the wrong expert involved.
Right.
And you can usually recognize what type of accreditation someone has by the letters after their name. So I think Raj is CA, CBV, ABV, CFF. So that means he's a chartered accountant, so he has the basic accounting background. But CBV means that he's the chartered business valuator, so he knows how to value business. ABV, accredited business valuator, and CFF, certified in financial forensics. So that means being able to, for example, compare bank account statements to what's been reported in financial statements, or to see where money went, to try to track where different transactions have gone. I'm using them now to try to figure out where, if someone has exemptions, where money can go, tracing for exemptions. So that can give you a little bit of an idea.
So Ken, I've been grandfathered on some of those, as impressive it is to have all those letters after my name. And so that just tells me how old I'm becoming here when I'm started to be grandfathered, right? So I'm a little bit hesitant having all of them, but yeah. Okay, so that's all I have about accounting, the accounting designations though. And I think we've talked a little bit about, okay, we're on to the YCBVs. Did you want me to address this one as well, Ken?
Yeah, I think the next few slides are yours here.
Okay, sounds good. So again, I mentioned that Chartered Business Valuators, that's a Canadian designation run by a national institute here, and they have reporting standards, including report standard number 310. I think that CBV designation is the most recognized by the family law courts in particular. So I think it's great to use my colleagues in that field. Because we're well educated to determine guideline income and business valuation. Those are two interrelated concepts here that have to be dealt with in your work. In particular, this is available on the website to the public under Code of Ethics and Standards, is standard number 310, and I'd encourage lawyers to be familiar with that, where they deal with the standard of work that has to be done in an expert report, and just to ensure that that's being done either by your expert or by an opposing expert. So I think that that's an important consideration as you review reports. Okay, so in regards to business valuations, there's various approaches that we can use here. And I think of this as a decision tree. And in the decision tree, if you go down one branch, you would have a liquidation. And a liquidation is usually a situation where this business just should not be continued. And unfortunately, during these COVID times, we have a few more of these situations where businesses don't have income and may not have the visibility to survive. And in that case, certainly to go down the path of saying this should the best or highest economic decision that could be made, highest economic value that can be obtained is to liquidate, then that might be a valid valuation approach, whereby you would take the assets minus the liabilities, and then you would deduct selling and tax costs to arrive at your business value. Then we have a bunch of going concern approaches. Within the going concern approaches, we can have an asset-based approach, an income-based approach, or a market approach. And examples where all of those would be applicable in the asset-based is, let's say it's a farm operation that's ongoing, whether it's grain or cattle, livestock. That is common for an asset-based approach, whereby we would take the assets minus the liabilities, but different from the liquidation, we wouldn't apply selling costs. We may still apply a tax discount if it's an incorporated business. So and that's perhaps a common application for all businesses. The next income-based approach is used, for example, something like McDonald's that Ken mentioned earlier, where we think that there's goodwill in the business, or it's earning more than a sufficient rate of return on its assets, typically north of 15%. And then we think that a buyer or a fair market value determination would include goodwill on top of the asset value. And where we have operating businesses, that income approach is most commonly used in the family law context in particular, perhaps because of the cost effectiveness of it, and also also in relation to being practical in terms of our reports. The market-based approach would be ideal, and you know, whereby we would have comparable transactions and we could apply that to the business value. Practically, this is rarely, if ever, used in the family law context. And the issue is having, in Canada, comparable private company data is not readily available. So it's hard for us to use comparable transactions. If you were to compare that, let's say, to the real estate industry, where certainly having comparable transactions for residential real estate is far more available. So in that case, you might see that being used in the appraisal value of real estate, but in our valuation context, we rarely are using it for that. The last comment I'll make here is that be mindful of the type of valuation report that you might ask of your expert. We have 3 different types of reports that we would use for family law matters: a calculation of value, which is the most cost effective, but may not involve all of the procedures that you would like to see if you're going to court, an estimate of value, and then a comprehensive report. And all of them have incremental fees associated with them. I'm going to say that a comprehensive is fairly rare. It's very expensive, and because of some of the cost considerations, it is rarely used. But the first 2 certainly are more common. So that's what I have on the business value, on the approaches. In relation to what we would like to obtain from yourselves as legal counsel, we're typically asking for the financial statements, the general ledgers, which we talked about earlier, for us to look at the transactions, the property, plant, and equipment schedules, and we may, depending on the need to go into personal benefits, for example, in more detail, or earnings adjustments for our valuations, we may end up looking at bank statements, investment accounts, or other credit card statements. Redundant assets, I'll maybe just define what redundant assets are. Redundant assets are assets not required for the business. So a common example may be the condo in Hawaii, which may be owned by the business. We would want to know if any such assets exist. There may be personal vehicles also in the business, and we may consider that redundant. Or other investment assets that are held that are redundant. And so we'd love to obtain a listing of that, and it may not be known up front, but it's something that we would inquire about after. Other items here that we would like to adjust, that we need to find out about and determine if adjustments required, if there's fair market value expenses. This perhaps gets caught up in the Cunningham disclosure as well, Ken, that you mentioned earlier. But otherwise, we need to inquire about those. And then non-arm's length salaries. So at times in the past, we've seen this was a common expense with salaries to children, salaries to spouses who may not have been active. And in that case, we need to make adjustments to add that back for both the valuation and potentially the salaries expense. I believe that might be an 18.2 adjustment for guideline income. So that's when we would consider those items here. Okay, and guideline income reports here. So guideline income, stating the obvious, it's used for determination of the spousal support and child support. And our basis for guideline income determination is the federal child support guidelines. We use the acronym FCSG. You're familiar with that, I'm sure. We're typically starting with line 150, which would be our endpoint for a lot of employees, let's say, outside of some of the other perhaps dividend or capital gain adjustments, which Ken mentioned before. But otherwise, for business owners, we take a step further beyond the line 150, and we have to determine whether there should be consideration to add back business earnings that were retained in the business and not paid to the business owner, which was discussed earlier. And there's a lot of considerations as to whether the business needs that income to remain stable, as was mentioned, or whether it needs to invest because of the assets have been depleted. So there's a lot of different considerations as to whether a business needs to retain its income. We may even have bank restrictions in terms of distributing cash flow or income. So these are all of the determinations to come to our guideline income. Okay, Ken, is this you now for making the most of experts?
Yeah, I suppose it could.
Okay.
So this is just a few tips about if you do hire an expert, what you can do to get the most out of them. And most of it is just realizing that they need to go off of your instructions. They might have a default, but really they need to know what you want, and you need to tell them what you want. So for example, how many years do you want to go off of? Are we looking at 5 years of arrears, for example? Well, most reports only provide about 3 years, looking back, if you're looking at incomes. So you can always ask to customize the report a little bit. And you have to make sure that you provide enough information, because if you don't provide enough information, then the report that's provided may be wildly inaccurate. So for example, I had one situation where the other side hired an expert to calculate income, but all the expert did was look at the financial statements and absolutely nothing else. Didn't try to contact the other spouse, didn't look at general ledgers, anything like that. And so the report was just wildly inaccurate.
And I might suggest, Ken, that it might be appropriate for yourselves as lawyers to ask for an engagement letter from the expert that will detail out the scope of work that they intend to do. And then, you know, upon your review, you can determine whether you need extra procedures or not.
Absolutely.
Yeah.
Yeah. So most experts will have a letter basically saying out what they're being hired to do. And so the point is that you're able to customize that, is that it's up to you to tell your expert what you need. Because if you don't tell them, it's not their fault. It's definitely the lawyer's fault. And then, for example, so in terms of providing them enough information, let's say if you're acting for the spouse who's not the business owner, but the spouse who is the business owner has provided an affidavit that sets out information about all of their expenses. So, for example, maybe that should be provided to the expert.
Yeah.
So they have enough information, so they know what the other side has disclosed as well. And it's just important to ask questions about the process and the results. And oftentimes, when we hire an expert, we'll have an initial teleconference call where everyone can ask these questions and make sure that they're on board. And you can discuss the depth of the report, how much detail do you want the expert to go into. And in some situations, we even get experts to come into things like settlement meetings. So oftentimes they'd be there in court proceedings, but you can also ask them to show up at other times where they might be helpful. Because a lot of the time we end up jointly retaining an expert. And I'm a big fan of that. When each side just agrees on who the expert is, use the same expert. That way they both get to provide information to the expert. They can each ask for adjustments. And the idea is that, well, they're spending less money because they're hiring one expert instead of two, but they're also both way more likely to agree to the result. If they both got to participate, both got to select who the expert was, chances are we probably just go with the expert's opinion and then move on. On the other hand, let's say if you've got a situation where each side hired an expert, the business owner's expert consulted the business, went into everything in detail. The non-business owner's expert did not. Well, one of those reports might be very reasonable and the other one might not be. And it wouldn't be fair to just cut things in the middle. And the business owner is probably going to say, no, I'm not going to agree to cutting things in the middle or going with the other expert's report. They didn't even consult me. And all of a sudden you're at an impasse because the non-business owner says, well, I trust my report, my expert, because they're independent and they're not some kind of hired gun.
Mm-hmm.
And there are some hired gun experts out there, but I prefer experts who are very neutral when we're doing a joint report. Yeah, you'll get a feel for who's out there, anyways.
That seems to be a trend. I was just going to say, Ken, and I think in BC the joint retention is a requirement, and it just seems to be a trend in your field. We're just seeing more and more of it as experts ourselves.
Yeah, and like the court can also appoint an expert. So in that situation, you probably have someone that everyone agrees on, anyways. But it just makes so much more sense rather than having a really expensive battle of the experts.
Yeah.
Makes perfect sense. And so Raj is an example of an expert who I would say is very neutral, very impartial, investigates what both sides want to make sure that each side's comfortable. So it's a good example. There's different valuators out there. Raj, do you want to touch on this one?
Sure. Yeah. So the types of the costs we have here ranging from 5,000 to 20,000. The guideline incomes from 3 to 12, and forensic boy, that is obviously an expensive venture, and I agree that 9,000 is a minimum, and boy, you can get to well over 40. I've seen $100,000 forensic reports, so they get very expensive. Some people think of forensic reports as detailed audits, and perhaps it's definitely a step beyond an audit for sure in terms of forensic work. The biggest driver of all of these costs will be, as Ken mentioned before, one is whether you're jointly retaining in terms of your total costs, because if you're not jointly retaining, you're probably going to have another type of a report here, which could be a critique of the other expert as well. So that can drive up your costs. But within this here, the business valuation, there's, as I mentioned before, a calculation of value, the most cost-effective report, and you have to make a determination whether that provides you with sufficient work if you go to trial with that. Or are you going into a battle, giving your expert a knife, going into a gun battle, right? So this is the issue in terms of the type of report. Otherwise, you have an estimative report or a comprehensive report, which involve a lot more work and then more expense to get you to the higher end of that range for sure. And the valuation approach is another thing that will drive this cost again. So if we were to use, let's say, an income approach, that's more expensive than an asset-based approach. And we rarely use these, but at times a discounted cash flow approach would be appropriate, which requires forecasting of future income and discounting that to the present day. That would also entail more cost here. So understand how you're engaging your expert, and that will drive the cost of the report.
All right, so we already spoke about how I really like jointly retaining experts. It's usually my go-to scenario in most of my files. In some situations, if you don't jointly hire an expert, maybe the other side's already hired theirs, you want to get your own opinion, you can choose to have the law firm hire the expert, and in that way it maintains privilege over communications with the expert, so it doesn't necessarily need to get disclosed. It does get murky because in the financial disclosure case, we'll talk about a decision called Chateau Bear, which basically says that if someone knows the value of the business, they're obliged to disclose it. So that might not be the case for business valuation reports. If it's the law firm that hires the expert, though, make sure you get a large retainer for them up front, because otherwise your firm is not going to be happy if you get stuck with the cost and the client doesn't pay it because they don't like the answer, or whatever the case is. Yeah. To finance reports, there are different ways to do it. That will be spoken about in other classes. So for example, there's an advanced cost application where you say, I need money to report legal fees, I have no resources, the other side has piles of resources. Interim property distributions to say, look, I'm going to get some kind of settlement, so why don't I get it now? Because that way I can afford some of these legal fees going forward. Or sometimes we even apply to sell assets so that everyone can afford their fees to get things resolved. And our code of conduct with the Law Society does say that we have to make sure that when lawyers are retaining experts, that it's in writing. If we're not responsible for the fees, make that clear. And you should be helping your experts collect money. So if your client isn't paying the expert, you should be helping them. You should be helping the expert to hound the client to make sure that they're paid up, which I'm happy that's in the code of conduct, because otherwise I'd be harassing clients anyways, but at least that way I can say it's part of my ethical obligation.
I'm happy too, Ken, actually.
Yeah, exactly. Works out for everyone.
Yeah.
And to your expert, they still have to be qualified as an expert. So your evidence class will talk about this. But in practice in family law, since most of our applications aren't in a trial, if we're doing something like a guideline income report that we want included, usually I'll attach it to an affidavit. I'll have the expert swear the affidavit. I'll have their CV or their resume attached to the affidavit so that there's enough information to show that they're properly qualified. Be aware that technically the other side can ask to question your expert, to ask them questions that are typed up by a court reporter. I've certainly done that a couple times, and the other side backs down pretty quickly rather than pay the cost of that, especially if there's a genuine issue with the report. There's also a way to file something called Form 25, which is when you're tendering your expert report for a trial. So there's a different form for doing that. But especially early on, who knows what you're going to be doing for trials. So sometimes you don't want to file that too early. And it's not entirely clear from the case law which you're supposed to be doing, but I tend to just submit the affidavit with their information. All right. So there are limits. Even if an expert does have the required experience or training, there's situations where their report can still be ruled inadmissible. So especially if they don't have sufficient impartiality, objectivity, or independence, it can be ruled inadmissible. A prior relationship with the expert doesn't necessarily mean it's inadmissible. The question is whether their opinion would change based off of who has retained them. So are they a hired gun where their opinion changes based off of who their client is? Can be difficult to prove though, certainly. Yeah. And also courts can't really delegate their decision-making power to an expert. So courts are supposed to analyze the facts. They can't just automatically say that they're going to adopt the expert report. So there have been people who've challenged expert reports by, for example, showing that the facts are different. Maybe the facts have changed over time. Maybe that party who hired the expert didn't provide enough information to their expert. So you can argue that that a court shouldn't just defer to the expert report. Although in practice, I would say most of the time, if there's an expert report, the judge is going to be deferring to it, unless it's a situation where there's multiple competing reports. There are situations, though, where, for example, fact-finding has been delegated, that a court has ordered a evaluator to try to figure out certain facts, or maybe they're tallying certain summaries or finding out where money went. And there is a court decision that said that a party doesn't necessarily need to hire an expert. They can still try to contradict that expert's report. Just be aware that not all judges have that mindset. Some really do like deferring to the expert's report, especially for an interim decision where they don't have a lot of time to go into everything. If there's an expert report that has issues, especially if it's a jointly retained report, you can sometimes just set up a conference call with everyone, each side and the expert in the room, to talk about some of the issues. Because sometimes reports would change if there's different facts brought to the evaluator's attention. So you can do the conference call. You can even just ask the expert if they've missed something. Just CC the other lawyer if it's a joint retainer. If it's the other side who has an expert's report and you don't really have the ability to contact them, you can hire an expert to do something called a rebuttal report, where they basically critique the other expert's report. Although a critique isn't an actual substitution for a report, so sometimes you also have to get your own expert to do their own report too. And sometimes you can question the other expert. So we're most of the way through the class, so if anyone wants to take a break, they probably should now. Raj, are you okay with keeping going?
I'm good. Yeah, let's let her rip.
Okay, perfect. Let's blow through this and just picture some CGI fireworks for most of the way through it.
Okay, awesome.
Yeah, you got to picture them or imagine them, because I probably won't actually get around to doing them.
Oh, Ken, you're disappointing me. I totally thought we would get those, and I thought I'd get the dolphin too.
I thought you were doing the editing.
Oh my gosh. No, I'm not technical enough. Sorry, buddy.
All right. So what we're going to go into next is different ways that courts divide business interests or deal with them. So we're talking about the actual assets. We're not talking about income anymore. So let's say if if both spouses are shareholders, sometimes the court will just say, all right, the other spouse will transfer their shares to one spouse, so it's one spouse owns the shares now, and then maybe we compensate them in some kind of other way. Maybe they get other property. Maybe one spouse gets the business, one spouse gets the house, for example.
And Ken, that transfer is important in terms of timing, correct? Like if we're going to do this on a deferred basis, whether prior to the formal divorce, I suppose, or.
Yeah. So I think Raj is referring to the tax complications that arise, and so we'll have a whole separate class on tax issues and family law. But really, what we're saying is that the Income Tax Act has rules about when spouses can transfer property between each other. So while you're married, you can transfer assets between each other without there being immediate taxes. The taxes are deferred. If people are unmarried, and then if it's after a very short timeline, I think, was it 90 days that you're no longer considered common law anymore?
Oh, yes, yeah.
Yeah, so after 90 days after separation, if you're common law, you can't really do those transfers anymore. So you can only do one final transfer as part of a settlement of property rights. So especially if people are common law, or if the divorce has already been granted, but we're still dealing with property, you just have to watch out about transferring shares, especially, or transferring really any property, especially if it's of significant value that might have gone up in value. So sometimes there'll be a buyout when we transfer over those shares. So maybe someone refinances other property to get funding. Maybe there's a bunch of funds in the company, or maybe we can withdraw some assets to transfer over to the other spouse to pay them out. Because sometimes people will put like their real estate in the business, or a lot of people will accumulate investments in a business. Because if they accumulate it in the business and then they wait until retirement to slowly pull them out, it can be at a lower tax rate. So sometimes that's how business owners do their savings. So sometimes there's already the funds there to be able to pay out the other spouse. There's also something called a butterfly transaction, where we split the company basically into two companies. And sometimes we do that. Sometimes there's just maybe there's different locations. So maybe there's a restaurant chain. One person takes 2 stores, the other person takes 2 stores. But sometimes it's, let's say if there's a bunch of cash in there, maybe we don't want to pull it out right away, so we transfer it to another company, and then the other spouse can pull out that money slowly over time. And there's just basic property considerations. So for example, we wouldn't want to just say that someone owes money. You want to make sure there's some kind of collateral in case they don't pay, or in case they declared bankruptcy. But what the court has said is that there's certain situations where this isn't appropriate. So most of the time we're doing this in most separations. But if there's no practical way to actually pay someone out, it's not enough to just say, all right, the spouse gets $1 million for their share in the business. If there isn't really a way to do that, to affect that money, then courts shouldn't be ordering that. I mean, really, should be a principle that the courts don't make impractical decisions. Should be a principle. I don't know. Don't think it really is, but
yeah.
Sometimes the shares are just divided. So maybe one spouse owns the shares, but maybe we say as part of the matrimonial property division that the other spouse gets half the shares. So in some businesses this makes sense. So maybe they only owned like 10% of the company, and maybe the other shareholders are all independent. So maybe neither of them are really involved in the day-to-day business of the company. Then that might not be bad. But making someone a shareholder when it's the other spouse's friends who control the business, maybe you're just setting up for failure, where they're going to try to find ways to harm that spouse. And if someone's a shareholder, or sometimes even when they aren't, they can sue in something called oppression, or bring something called a derivative action to sue on behalf of the company. You'll go over that in your corporations class. But that is a possible remedy, so they're not just out of luck, but it's not simpler, and it can be costly to have that kind of litigation. So you don't want to set people up for failure either. So the courts have said that that you can refuse to just divide the shares between the spouses if there's a significant possibility of oppression. But there should be that kind of history. So courts will also look to whether there's history. So, for example, was someone fired? Was someone mistreated? Maybe all the compensation just went to one spouse. Maybe the corporation issued a bunch of new shares to try to make that other spouse's shares worth less. Whatever the case is. There's situations where maybe the shares can't be divided because of something like the bylaws or articles or unanimous shareholder agreement company that says shares can't be transferred to anyone else without all of the other shareholders consenting. So that often happens when there's third parties involved. So let's say it's a few different families who each own a quarter of a corporation. Maybe they have something like that involved because they don't want to be doing business with who knows who down the road. If someone gets into a new relationship with someone who could cause trouble or create disharmony within the corporation. So in that case, if shares can't actually be transferred, sometimes courts would say, all right, well, we can't transfer the actual shares, but we can say that the shares or half the shares are held in trust for the other spouse, so that half the income that comes out still has to be paid for them, or whatever the case, whatever the specific terms are. So sometimes that happens. And there are situations where courts have put into place very, very specific instructions about how income is to be divided, how returns of capital, returns of the investment are to be dealt with, and what a person can do with their shares. So I've listed a few of those. And sometimes we also deal with these arrangements, whether it be ordering shares be in trust or just dividing shares, where we just don't know what a business is worth. So if we don't know what a business is worth, if we can't value it, if we don't actually know what to pay someone out, maybe we have to look at something like this.
Yeah.
All right, so again, a few different decisions, a few different basic principles. Another option is that sometimes courts will just order that the shares be sold. But usually we don't want to do this. In a lot of situations, for example, like a farm, that farm might end up being the kids' farm one day. And so if we just order that something be sold, then maybe everyone has less income. Maybe the kids eventually miss out. Maybe people lose their whole lifestyle by not being part of that business anymore, especially if they identify with the business. So it's often not ideal, but sometimes we do it because there just aren't a lot of other options, or maybe none of them want to be involved in it. Maybe they just see it so impractical. For example, maybe they just say, like, I'm just not willing to pay out my spouse $1 million. That would be impractical. I couldn't afford the financing. Let's just sell it instead. I don't want to keep it if it's worth that much. I don't make that much money off of it. Sometimes the kids are a little bit older and we know that they're going to take it over anyways. Sometimes maybe the deal is that we set it up so that the kids take over it, or maybe the kids buy off the parents over time. So there's something called an estate freeze that can be put in place to help that happen. But sometimes courts have even said that maybe a share sale isn't appropriate, where transferring, especially a portion of the value of a whole company to some strangers might be worth a heck of a lot less. So let's say if the other shareholders are all friends of the family, then by selling to some kind of stranger, they just might not be willing to pay a lot compared to what the business is worth. Another thing that we do is sometimes we just wind up the company. We say, let's slowly sell everything off, close everything down. The court can even do that, especially if ownership is just unsustainable. So that's happened, mostly in civil law cases, though. So most of these that have been cited are civil law here, where courts even put together complex auction regimes, and so a few different decisions there. There's also situations where you put into place tax plans. So we'll talk about that more in the tax class. But sometimes we'll, like I said, sometimes we'll split into multiple companies. Sometimes we'll intentionally trigger capital gains tax because spouses, when it comes to businesses, have a certain amount that they're not taxed to throughout their whole lifetime. That's about $1 million worth of value. So sometimes we'll use up a spouse's lifetime capital gains exemption, so that if the other spouse ever has to sell the business in the future, they won't pay taxes. But the courts, there's at least one decision that has said that the parties basically have to agree to something like a complex tax plan. Okay, a court does have limitations about what they can do. I don't necessarily know if I agree with that line of reasoning. I'm not sure, because the court does have a lot of discretion under the Family Property Act. It's been interpreted to be fairly broad. So I don't know if that's quite the case legally, but certainly I can see why judges would not want to deal with complex tax plans where there'd be resistance. And it is debatable whenever you're asking for something that's not explicit in the statute that says that you can ask for this. But it is something that you can agree to as a part of a settlement. Sometimes we even, like I said, we divide divisions. So maybe it's a whole restaurant chain. Each spouse gets half of the restaurant locations, for example. So again, it's probably by agreement. I don't know if the court can really do that. I don't think I've seen the court actually do that. But most of the time we're resolving things outside of court anyways. So it's important to know what the settlement possibilities are. But if you do split divisions, you definitely want to talk to a business law lawyer, because there's all kinds of issues that might come up, like non-competition and confidentiality, and signing authority, and who gets to use the website. And maybe you've got I had one where they printed out a bunch of grocery bags with the branding and the logo on it, and we had to argue about who got the grocery bags and who gets the social media account, who gets to use the name. Are we changing color schemes and fonts? And so I've gone into this much detail before in situations. And another possible scenario is that sometimes the business just isn't worth anything. If someone's business is really part of a multi-level marketing scheme, for example, most of those probably aren't really worth anything. I'm guessing, anyways. So there are situations where courts have said that businesses just don't really look like they're worth anything. And my rule of thumb is that the more employees there are, the more likely I'm going to get a business valued on board to try to get things valued. Like if it's a one-person company that probably can't be sold, it probably isn't worth more than its assets. Sometimes we just try to value what the assets are. But for larger corporations that have multiple employees, that's when we tend to say that they're worth more than the assets. That's when it tends to be more likely. I know it's definitely a lot more complicated than that. But yeah, some businesses, if it's just a one-person shop, then it might not be worth anything. But if there's ever any doubt, you definitely want to consult your chartered business valuer, because usually you can at least get a phone call with them, and they might. I've often been told, because I'll call an expert and I'll just say, hey, do you think there's any point in valuing this? And they tend to be very honest. They don't want to put a bunch of time into it to say that it's worth nothing. They're going to end up with unhappy clients. So they tend to be happily provide that information consultation. Where at least in Edmonton, I don't know about the rest of the province, because I really only know Edmonton's chartered business valuer community. But we're lucky to have a pretty good group of valuators out here.
Ken, have you run into the situation where, as a recipient, I'm also financing the payor spouse over time, and how does bankruptcy? I don't know if you know how bankruptcy relates to that circumstance, and whether that's a risk as a recipient spouse if I'm financing the settlement of assets.
If the recipient is financing it, I guess it would depend on the exact structure. But like really any time where there's financing or where there's just an order that's meant to be paid, then that's always an issue when it comes to a bankruptcy. That's why it's always wise to get some kind of collateral in place or some kind of mechanism to say what actually happens if the person defaults. You always want to get that in mind. Yeah, it definitely depends on the financing, because if a recipient spouse was financing it, then then not only could they be out of money, but they could also be responsible for the financing. So it would just be very, very high risk to that recipient. But yeah, sometimes it depends on the amount of trust.
Okay.
I've seen some pretty sophisticated arrangements where people trust each other. Sometimes they're a little more likely to play ball and get into some more creative arrangements.
Okay.
And it probably just depends on the amount of risk in the business too. Because if it was a really volatile industry, then I certainly wouldn't want to provide financing to help someone pay me. But if it was a very, very steady industry that had been around for quite a while, maybe that might not be the case.
Yeah.
All right. And then if you do transfer shares, there's a lot of different things to take into account. So for example, if someone's a director, maybe even before the shares are transferred, sometimes I'll send a director's resignation fairly early on in the separation. It's actually part of my intake questionnaire to ask people if they're still directors, if they're not controlling it anymore, because they might want to resign just so they're not liable for things like GST and employee source deductions that aren't paid to the government, or environmental damage, or a few other scenarios that directors can be liable for. Like sometimes people say they want to remain directors so they can keep making the decisions or keep getting information, but you can still get information through the courts. And a lot of the times after separation, they tend to be excluded from the decisions anyways. And if they're a shareholder, then in some situations, if their shares are improperly treated, then they might just have a claim for oppression anyways. So there's a lot of situations where they might just want to resign as a director rather than avoid liability. Let's say if the other spouse doesn't pay their employees tax remittances. All right. And if we're transferring shares away, sometimes I'll even do like release documents where the spouse who's transferring the shares away and the corporation each release each other from liability. Again, you can just get a corporate lawyer involved. They can do a lot of this stuff for you. If you're transferring control of business from one shareholder to another, they should be aware that it will probably transfer a new financial year end, that they'll probably have to do a new set of financial statements. So you want to speak to an accountant about that. All right. I mentioned before that that you can look into using up someone's lifetime capital gains exemption, where they don't pay capital gains on 2020, it was up to $883,000 of gains they'd have to pay taxes on. So if a spouse has no interest in being part of a business ever again in their life, especially if they're older, it's pretty obvious that they're not going to be part of a business. Sometimes it's worth using that up. And it can help them too, because if it means that we're applying less of a tax deduction against that business, because they're helping us minimize the taxes, then it's good for everyone. It means the equity in the asset's worth more, so they ultimately get more money too out of the settlement. But you really shouldn't negotiate that. I don't see a court ordering that. Keep in mind that if you transfer shares out of a corporation, then there could be taxes. Whether you pay yourself $100 or you give yourself $100 worth of inventory, or you have to transfer a house out to yourself, there could definitely be taxes on that. So just be aware of that when you're structuring arrangements. And if it's a sizable amount of money that someone might withdraw over time in retirement, something like a butterfly reorganization set up by a tax accountant can definitely be helpful. And there's also something called a pipeline, but really just consult either a tax accountant or a tax lawyer if you run into those kinds of situations where you have to minimize taxes. I'm going to skip over some of these things because we'll talk about them in the tax class. But just keep in mind that when a large amount of taxes might become payable all of a sudden, you definitely want to speak to a professional, because that's where you might run into liability as a lawyer if someone incurs a whole pile of taxes because you didn't think about it ahead of time, or if they end up paying more of a settlement payment because we didn't reduce the value of the business by the taxes paid. That could turn into liability as well. So the client just needs to be informed. They can make whatever decision they want after. So always want to consult the proper professional. So one of those proper professionals that you might want to consult is apparently a divorce cake baker. So
love those.
Apparently this is a thing, divorce cakes.
I think it's a great way to celebrate here. I love it.
Yeah.
Yeah.
It's funny too, because when I was looking these up, there were so many of them that were just extremely violent. These are the PG ones that I felt comfortable putting up on slides. But it was amazing. Like, there were spouses throwing each other into wood chippers and blood everywhere. Some of them were pretty bad. Yeah. I mean,
this is an important profession to consider then, I guess, right? This is the way to sell. Yeah. Yeah.
And the most disgusting one is definitely that one in the middle, find the toenail. Oh,
oh yes. Yes.
What a cruel person.
That's terrible.
All these other ones were fun. That one's just cruel.
Yes. Yeah.
All right. So I mentioned before that sometimes shares can't actually be transferred because of something like a unanimous shareholder agreement or articles that say that shares can't be transferred with the other spouse's consenting. So I just have the law in here. So there's been multiple court decisions that say that family courts can't override corporate law, basically. But there are situations where corporate law, just what's in place just overrides corporate law. So, for example, some people have had unanimous shareholder agreements that say that even kind of trust arrangements are prohibited. But that's not really regulating the corporation anymore. It's regulating the relationship between the shareholder and other people. And so that's just beyond what a corporation can do. So family courts can ignore that. And there are ways to, if someone has been treated unfairly and you're able to bring one of those corporate law claims, like oppression or derivative actions, under the Alberta Business Corporations Act or the Canada Business Corporations Act, courts do have the power to modify those types of documents. So, for example, to change the articles to take out those types of terms so that someone can sell their shares, for example. So you can bring a separate claim to be able to do that. And even if someone can't transfer shares, it might just mean that maybe the other spouse gets more of the other property if they can't get shares. So it doesn't mean that they lose their claim by any means. And we're talking about where there's third parties involved. So even if those types of restrictions were in place, if there's only the one shareholder and it's only the spouse, family court's probably going to ignore that. And one way to get around those restrictions, like I said earlier, was to put a trust in place. So here's a couple decisions where that's happened. We won't go through each of them. If you're ever helping out with business planning, or if people are asking you what's safest, if you want to make sure that business is preserved, if you want to make sure that it doesn't get split up, for example, if you want to keep it around so the kids can inherit it. If there's third parties, unanimous shareholder agreement, bylaws and articles restricting the transfers of shares will at least usually help those third parties. But really, if a client is looking to preserve a business, then really they should have a prenuptial agreement or cohabitation agreement or postnuptial agreement that deals with those assets and deals with property rights that involves the other spouse properly. It's also worth mentioning that there's certain businesses, so professional corporations, where oftentimes there are limits on who can receive shares. So just be aware of that. If someone has a professional corporation, usually the industry regulating it. So usually we talk about different professions like accountants and dentists and lawyers. So for example, the Law Society has rules on who can own a professional corporation that owns a law practice. And other industries have that too. Like dentists, I've had run into that. But those might be out there, so the same law would apply. There's a few decisions on whether something is property or income. Part of that, like I said earlier, is to make sure that we're not double dipping to count something, to pay something out as both property and income. So if one spouse gets a business and we're paying out the other spouse based off half the value of the business and half the income that comes out of it, it's double dipping, double counting, because basically they're getting the whole value of the business. So just be cognizant of that there are decisions that have said, especially for spousal support and partner support, double dipping should be avoided, but sometimes financial need will trump that. So there have been situations where years later, someone's depleted all of their property, and the other spouse who managed everything properly is getting their money from a business or pension, and even though the spouse who depleted their property already got paid out for that business or pension, sometimes they still end up getting spousal support if it's a long enough relationship. I know that's contentious decisions, but they do happen, because it definitely sounds unfair for someone to have to pay a spouse twice, because ultimately it means that they don't really get anything. One way that we treat this when it comes to spousal support, and business isn't specific, that I want to mention is sometimes we can just segregate that income. So even if we agree that a spouse is entitled to support, maybe we say, let's figure out how much of a person's compensation is the profit or the dividends, and how much of it is a salary, where even if they sold the business, even if they didn't have it, they could still be making that amount of money. And either the other spouse is in financial need, or the other spouse, maybe they even helped that spouse get into that career, looked after the kids while that person developed that career, then maybe we still have spousal support being paid based off of what a reasonable salary would be. But maybe we say that spousal support doesn't get paid based off of the profits or dividends. So that's one way to do it. But spousal support is definitely a lot more complicated than that. So I think by now students will have been in the spousal support class. So hopefully you heard Laura Breyer speak about that a little bit. And there is one decision where it was said that it might not be double dipping if we're not valuing a business based off of its income, but based off of its assets, especially if the assets aren't really worth a lot. So I've had situations where maybe the business isn't worth anything, or maybe it's only worth $1,000, and so the other spouse gets $500. Well, if the business isn't really worth anything, but maybe they're still able to derive an income out of it, because maybe it's just a one-person business that no one would buy, but it still makes that person $100,000 a year, then maybe there still should be spousal support on that. So there is case law to back up those types of theories out there. All right. So I don't want to go through each of these because we'd be here for quite a long time. When you start looking at a corporation's financial statements, especially its balance sheet that shows its assets and debts, you might see that there's certain transactions called shareholder loan or amount due to shareholder. So if a company owes money to the shareholder, and if there's an amount due to shareholder, it's technically it's a family asset at that point. It's an asset, So sometimes we'll list it as an asset in our property calculations, and technically it balances out at the end of the day. It doesn't actually mean that any cash changes hands, because it's a debt to the corporation and an asset to the family. So it means the company is worth less, the family has more, and it's ultimately neutral. But you just want to make sure that you're not. You want to make sure that the company is worth less than it really is, just because of this notional accounting entry, where it's the family themselves that technically owes the money, is technically owed the money. And a shareholder loan is the exact opposite. So it's where the shareholder owes money to the corporation. So it's a debt to even though it'll show up as an asset to the business, it's a debt to the family. So in your property calculations, you want to be able to show it as a debt to the family, so that you're not using the wrong value for the business. When it comes to support, there are decisions too where, let's say someone is owed a lot through their shareholder loan ledger, amount due to shareholder. Let's say that there's $1 million owed to the shareholders because 10 years ago they put in millions of dollars worth of property into the business. And so going forward, they're just getting repaid for what they originally invested. So they're not taxed on that because of the amount due to shareholder amount. But then when it comes to income calculation, because they're not taxed on it, it doesn't show up in their tax return, then their available income for support purposes might show up a lot lower than it really is. So courts have said that if someone is basically relying on a shareholder loan and they're not really getting other income, that's how they're getting their income, then maybe it would be reasonable to add that back into their income.
Interesting.
And otherwise, I'm not going to bore you to death in shareholder loans because a lot of it is very practice-based, depending on specific circumstances. But there's definitely situations where courts have added back. Same thing, there's decisions about stock options, but they tend not to come up, especially in Edmonton. I've heard it that in Calgary, they tend to come up a little bit more often. So there's decisions about how usually their property, unless it's after trial, after property has been divided, then maybe we're just considering them income at that point, still being alive to double dipping issues. I didn't mention it before, but when we talk about double dipping, both getting half the value of an asset and getting half of the income coming out of it, usually we don't. Usually we don't care if there's double dipping when it comes to child support. So usually we're only trying to exclude double dipping and avoid it when it comes to spouse support, not child support. I didn't say that before, so I just wanted to make sure that was clear.
Yeah, that's important. Yeah.
Yeah, so lots of decisions about things like stock options, but we won't go into there because this next topic, we've got a few farm puns for you.
So Ken, I've got a question for you. How do you get the farmer's daughter to fall in love with you?
You attract her.
I like that's good. I like that. Very good.
So this late in the class, you got to have a few jokes, even if they're really corny puns.
Yeah, you got to keep it live. Yeah.
All right. So just wanted to have a really general overview on farms because they do get complicated. In that handout, my guideline income manual, I go into a bunch of different farming adjustments. But it's just a good idea to know a little bit about farms. So in Alberta, we usually have either grain farms or livestock farms. They're often held in families for generations, so there might be millions of dollars worth of assets there, but it's not necessarily something that someone's going to use, as oftentimes they're setting it up so the kids can eventually inherit it. Because a farm is a good example of a business where it's very rare to have an income-based valuation where we're valuing it based off what kind of income it can make. Because farms make very little income compared to the assets. Usually the assets are worth worth way more than what the farm is worth as an actual income generating business, because they need to have accumulated all these assets over time. So it's a very interesting business. It's usually because of the history that they've been able to accumulate all these assets and all this farmland, not because farming is a profitable enough business that they've been able to acquire millions of dollars worth of farmland quickly.
Yeah.
Depends on the farming operation too, because some of the really large scale ones can be very efficient and fairly profitable, but a lot of farms that you'll run into are probably going to be where people don't really have a lot of farm land. Sometimes we call it a hobby farm, where it's more for lifestyle purposes. Maybe they're semi-retired. Maybe they grew up in farming. So it's not where they have just piles of land. It's where they have a little bit of a farming operation going, but maybe it's not even their primary type of business. Because in Alberta, generally, we're seeing farmers who either harvest crops, so usually grains in Alberta, or livestock, so cows, pigs, chicken, whatever the case is. And someone who's a grain farmer, usually for grain farming, there's parts of the year where you're very busy. So when you're planting seed or you're picking rocks, or you're harvesting the crop, you're incredibly busy for those times of the year. But in the winter, there's not really a lot going on for grain farming. So a lot of those people will have a separate job, for example. But it depends on the size of the operation. So it can be difficult when there's a separation, because if you have this asset that's intended to go to the kids, that's been in families for generations, if it's already been in the family for generations, there's probably an exemption already. But sometimes that exemption might be fairly small, because maybe the spouse is put on title, and so you lose half of your exemption if it's put into joint names. If it increases in value quite a bit, and we're talking about farms that might have been held for a couple decades long of a relationship, might have increased in value so much that there's a huge payout to be able to sell them off. So family law doesn't really distinguish when it comes to farms. Not specifically, but indirectly you can address farms. So for example, sometimes we'll just agree that the farm will go to the kids, and then if it doesn't go to the kids, then it gets liquidated and both spouses share in the value. So sometimes people agree to that voluntarily, especially if they have the kids together. If someone's a step parent, they might not. They might just insist on the value of the land. You can you can argue for an unequal division if there's an exemption. If it's just increased in value, who knows? You could run into a sympathetic judge, or sometimes it's just inevitable that that some of the farmland needs to be sold off, and unfortunately, sometimes that means that farms just can't continue, and unfortunately, that's a consequence of just family law. If people are putting in especially a lot of time, or if people are devoting themselves to a relationship, then maybe that's the only way to do it, to be able to pay them both out. And sometimes if they're both interested in farming, you just divide the farm in half, depending on things like exemptions. And just keep in mind too that a lot of farms have special tax rules. So it's definitely worth speaking to an accountant or someone familiar with farms. And you could also look at maybe if someone is fairly close to retirement, maybe defer distributing the property until the retirement, especially if the other spouse doesn't have any immediate cash needs. Sometimes you can even subdivide land. So, for example, you might have a large quarter section of land. Usually in farms, we're talking about quarter sections of land, 160 acres at a time, which is hard to picture unless you drive through rural Alberta, in case you came from a farming background. But a lot of these quarter sections of land, back in the day, all of them had houses, because you could only farm the land around you. And over time, what happened was that as farming machinery became more efficient, farming methods became more efficient. You didn't need, one family could farm more than just their quarter section at that point. So one family might now farm 20 quarter sections of land. So all these houses that were left over basically became acreages, where there's a spot in the middle of the farmland where you can build a house. That's where you can maybe sell it off now. And so the same thing can sometimes happen in a relationship, is you might say, all right, well, maybe one person gets all the farmland, but this big grand house that's on this quarter section, maybe we legally subdivide it and we either transfer to the other spouse or sell it off. So that's certainly an option. I already spoke about how you might just be looking at the value of the assets. So you might be looking at more of land valuation plus the equipment and some other adjustments. You could still involve a chartered business auditor because they can oversee a lot of that, and the cost will usually be a lot lower. It's an asset-based valuation anyways. There are equipment appraisers out there who can appraise all the farm equipment. And when it comes to inventory, if they're grain farmers, they might have grain, or if they're livestock farmers, they'll have cattle. And there's often places that will list the value of that. So for grain, the local grain terminals where the grain gets loaded onto trains, a lot of them have websites now that list the value. Cattle auctions will often list the value online. So it's a good age technology to be able to look that up easily.
Hey Ken, I got another question for you.
Yeah.
Why do cows have hooves instead of feet?
Because they lactose.
Oh, that's good. I like that. Good. Yeah, you can tell we're getting to the end of this here as the joke's a little cornier, hey?
Yeah. Oh, I love them.
Okay.
So the other thing to be aware of when you're settling farm divorces is that there are some corporate law aspects to sometimes be aware of, or maybe not corporate law, but just business law in general. So for example, livestock might have brands, and so you might have to file brand release forms. There's a company that seems to do most of that called Livestock Identification Services. So you can contact them. Sometimes if people have livestock, they might let the livestock go onto land that's not theirs. So that's called grazing. And sometimes there's even government grazing sites. So sometimes you have to look at filing assignment of grazing leases. I like contacting the local small town law firm that's close to the farm, because they usually know this stuff very well. And like I said,
oh, sorry, go ahead. No, you go ahead.
No, all yours.
Another question. Why do farmers party, Ken?
They turn it the beats.
Yeah, that's good. I like it.
So like I said, my guideline income manual sets out a lot more detail about how we deal with farming income. And it's easier to refer to that, but just know that you're a lot more likely to see personal benefits come up in farming income. So a lot of people treat farming income with some kind of mysticism. But really the big difference when it comes to farming income is that people are a lot more likely to write off their house if it's part of the farmland, for example, and vehicles are often intermingled. Like I said, you might use your quad to pick rocks and for the kids' recreational activities. So personal benefits have a lot more to them. And sometimes the farm is just a hobby. And sometimes maybe the livestock is really more of a pet or used for something like rodeo, something recreational. So sometimes we make adjustments there. There are situations too where, like really the only big adjustment that farms can do to their income is something called inventory adjustments. But that just really rearranges income between years to an extent. So I tend not to go into that detail in most cases. Sometimes averaging is very appropriate for farms where their income is based off of the weather, not things like global recessions necessarily. All right, so do we have any other farm jokes left?
Last one. I know everyone's loving these here. What did the mama cow say to the baby cow, Ken?
It's past your bedtime.
These are great.
All right, family trusts. I think this might be the last topic here, which is good because I think we're right towards the end of our time here. If we've gone over, we'll just make another class shorter. Sorry about that. So family trusts. So trust is where there would be a trustee who basically controls some assets on behalf of someone who either receives the income or is eventually going to receive the property as the beneficiary. So sometimes, especially when it comes to businesses, sometimes people put the business into a trust so that they can decide to pay some of the, so they have discretion to pay out the income. So they might pay the income out to the spouses, they might pay it out to the kids. Sometimes it's entirely intended that it's a way for the kids to eventually get the business. So it's very fact specific. Usually there'll be a trust deed setting out how it's set up. And so courts have said, we're going to look at the history when we're deciding whether we're going to treat this as matrimonial property or not. If the spouse is always just treated as their own asset, we're probably going to treat it as matrimonial property. Like if they're always taking out draws to themselves, if they got all the profits, if they've been taking assets out of that, it's one thing. On the other hand, there's some family trusts where the parents never take out any funds, and the intent has always been to leave everything to the kids, especially smaller businesses or trusts set up just out of some of the profit. And so sometimes it just depends on the history. Sometimes it depends on the trust deed. Does the trust deed actually say that everything just goes to the kids, or maybe everything goes to charity? Or is there still that discretion to pay to the parents? Has that discretion actually been used to pay money to the parents, or has it only gone to people who aren't the parents? And sometimes courts will say that both spouses can just be the trustees. But courts have also said that maybe that's not appropriate, where it could lead to a stalemate. So there's a couple decisions that basically describe these principles. But I'll let you go through the slides if you run into any of these issues and practices, because I think that covers trusts in a nutshell. All right, the next thing that we're going to talk about is misfeasance. So this is where if you're looking through someone's financial statements, their bank accounts, their corporate records, and you see that there's something that's not quite right, these are a few of those things that pop out as a red flag, and then we're going to talk about what to do about them. Because you don't want to just run into court and just scream that something's not right. You want to find out what's actually going on so that it's not your misunderstanding that's leading to the matter being unresolved. You definitely don't want to be in that kind of position. So a few things to watch out for. A big one is separation of a business after separation, especially if it's a friend or family member. That's always going to look suspicious. And you have to find out why it happened. Did the person actually pay anything? Are they actually involved? Or is it just that they thought that's how they could avoid liability for support or to pay out for property? The other thing is that we often see new partners who are employed by a business. And so again, you have to find out, are they actually providing services? Because maybe the former spouse was the bookkeeper for the business, and then after the separation, they had to convince their new partner to help out with the business. Maybe it's something like that. Or maybe, again, it's just a way for them to try to split income, because a lot of families try to split income during the relationship. So a lot of time they'll continue doing that after the relationship, and then it's on them to show whether that compensation is reasonable or not. A couple other situations is sometimes you can just look at the pattern of revenues and expenses. So for example, I've got one that I'm working on right now where the revenues have been pretty stable, but all of a sudden the year that the court action starts, all of a sudden the expenses just skyrocket. And it looks like the spouse is probably claiming things like their legal fees for the separation through the business. Looks like they're claiming all kinds of travel and maybe even a new partner, who knows what's going on there. But either way, it's strange when a business remains fundamentally the same and the revenues are pretty much the same, but the expenses just double. Sometimes too, we'll see that expenses are the ones that stay the same, but then the revenue plummets. And if it's a type of industry where they can receive cash, maybe it's because they're not reporting all that cash anymore. So I've seen that happen at least once. I don't think it's that common because we tend not to use cash that much. And if it's business that provides services to other businesses, the other business probably wants a receipt so they can claim a deduction for their expense. They tend not to want to just pay cash without a receipt so the other side can not pay taxes, but it forces them to. So it depends on the business. There's some people who just claim that they don't get any kind of personal benefits, don't benefit personally in any way from any expenses through the business. And for any decent sized business, something where they're working full time, why wouldn't they claim a bunch of expenses that also have a personal benefit? To an extent, you're allowed to under the Income Tax Act. Like, let's say if you've got a cell phone, why wouldn't you claim the portion that you use for the business? Or maybe they do have a separate business and business phone and personal phone. Same thing with vehicles or home office. Why wouldn't you claim part of the home office if you use part of your home as an office, or if you use part of your vehicle for business? But who knows? I mean, in larger businesses, maybe they only own a 20th of it, and they just don't get any personal benefits. But it's something to watch out for. Another one is if there's a lot of round numbers in the financial statements, or really round dividends in their personal tax return. I've seen that a couple of times where an accountant basically just put in a stand-in number where it didn't really correspond to anything. They just wanted to make sure that the taxes were paid, I guess. Another one is if the house is owned by a corporation. So I've seen people think that means that they can write off all of their personal expenses. So a few red flags to watch out for. Even it might not even mean impropriety. So for example, if the house is owned by the corporation, that just highlights, for example, how a lot of farms where they own the larger farmland, a lot of the time the house will also be part of the corporation or part of the business. And farmers tend to deduct a lot of personal expenses. It's just part of the business, part of the lifestyle. It's difficult to extricate the personal and the business components. So things to watch out for. But again, the idea is that you don't want to just make really crazy demands. You don't want to get your clients' hopes up too high because there might be an explanation for all of that. And you want to be very clear with your client that you're going to look into it. But it could be something improper or might not be, because you don't want to get your client's expectations high and then have it turn out that it's really nothing that significant at the end of the day. Maybe there is a reasonable explanation. Maybe it'll fall into one of the exceptions. So make sure that you look into it, ask for whatever records you need, ask for whatever explanation you need, give the other side an opportunity to respond. But otherwise, just make sure that it's not your misunderstanding that's causing the problem. Same thing as you might increase tensions by sending offers that are just completely wild, and all of a sudden the other side is worried about how they're going to survive and can ramp up the tension, and then maybe it escalates parenting conflict. So again, just watch out that you don't ramp up the tension yourself. So again, you can ask for specific things you can do is you can ask for further documentation, further information. You can go through a questioning. You can consult your own accountant to see what's going on. You can have a forensic accountant providing information or at least some kind of preliminary opinion. You know, that can often be quite expensive. You can hire an expert. An expert is a great way to dive through some of these issues. Sometimes we even have court orders that say that the expert can contact the other side or request information from the bookkeeper or the accountant, and they can do a little bit of an investigation themselves. And when there's misfeasance, another thing you might want to consider is that in some situations, it may be proper to bring a civil claim, especially under the Business Corporations Act. So for example, if your client's also a shareholder, there might be an oppression claim. A derivative action lets you bring a claim on behalf of the company. Sometimes you have to bring an injunction. If a corporation struck, sometimes you have to revive it if you want to make it a party. There's all kinds of remedies under the Business Corporations Act. So if there has been impropriety, sometimes that gives you more options, because there's things like investigations, getting an accountant to go through all the books, come up with a report. Yeah, sometimes there's things like debt claims against third parties. In some very extreme situations, there's been a civil conspiracy tort where other people have been involved and have basically tried to defraud a spouse. And it's a fairly high bar to prove that, though. Just be aware of that. And if you involve other parties, your client might be liable for costs. But there are a lot of situations where I'll involve a third party who's been involved in some type of misfeasance, because I've had situations where all of a sudden that third party puts a lot of pressure on the misbehaving spouse and backs out of the arrangement, and all of a sudden the misbehaving spouse claims that it was some kind of error or misunderstanding or whatever the case is. I've had that happen. Then all of a sudden we're back to a more reasonable standpoint, just because that third party doesn't want to be sued or be part of a lawsuit. Didn't realize what they're getting into. Just be aware, though, that you don't want to be too extreme, too aggressive, because there have been situations where that's backfired, even backfired when it came to things like parenting, because you don't want to look like a bully. And I'll let you go through these slides if you want to later, but that's the crux of it. There is one decision I want to speak about very quickly, though, and it's called Aubin and Patron, and it's a decision which was upheld by our Court of Appeal, went to the Supreme Court of Canada. The Supreme Court of Canada denied leave to appeal, but I bring this one up because of some misfeasance that didn't quite arise to fraud, at least, but still misfeasance. The non-controlling spouse, the one who didn't have a controlling interest in the company, was able to basically get a mortgage over a building owned by the company, even though there was third-party shareholders. So this is a very recent decision, because the Court of Appeal only heard it last year. Same thing with the Supreme Court of Canada denying leave. And before, to pierce the corporate veil, there typically had to be something at least akin to fraud, if not fraud itself. And so we have this situation where there's third parties who would normally be able to prevent someone from taking assets from a company, especially because there was share transfer restrictions in place, and there was the concern that there would be prejudice to third parties. But because the spouse who held the controlling interest in the company had debatably misbehaved, because looking into it in more detail, some of this was fairly common for a lot of corporate situations where there's two spouses, and the shareholders don't want warring spouses operating businesses. But because of what happened, the spouse was able to get additional rights in the company. So if you're representing someone who's planning to keep the company or controls it, you basically want to make sure that they don't take any incredibly aggressive steps without really thinking it out and speaking to you, even if their corporate lawyer says that it's a perfectly valid, legitimate legal step. So here, for example, there was a dispute about how proceeds were to be used when some of the wife's shares were repurchased. The wife basically took the money out of the corporate bank account herself. The husband retaliated by removing her as director, as an employee. There was also they had a loan from the company to buy basically a vacation property, and later on in the litigation, by the time that the trial happened, the wife was living there, but the loan had become payable. The corporation also had the right to make a demand on the loan. They'd done that earlier. but the court, I think, was of the opinion that, all right, well, during the relationship, you were able to get things like loans from the company to buy vacation properties. Obviously, you have a little bit of control over it. You probably could have let the wife stay there a little bit longer. Technically incorrect on corporate principles, but maybe that was the practical reality of it. It's tough to tell. So the end result, though, and sorry, there were some other things that had happened. So, for example, they had adult children, and the husband had spoken to the adult children and tried to get the wife committed to some kind of mental institution or assessment.
God.
I don't quite know what happened, but it sounded pretty awful.
That is terrible.
Yeah. So that was absolutely horrible. But it's still strange in line with the case law, because under the case law, like really it has to be what the business is doing. Is the business mistreating a shareholder to the extent that the shareholder should be able to pierce the corporate veil? And that was something completely separate from the business, really. So taking wrongs between spouses, ways that they've mistreated each other, to give someone rights in a corporation where there's third-party shareholders, that part was very strange. But if you're acting for the spouse that doesn't control an interest, then this decision is a phenomenal tool.
Yeah.
For those of you who become corporate lawyers and you're worried about spouses causing trouble in businesses or how to advise clients, you're going to have a really rough time, though. Business law lawyers are not happy about this decision. But yeah, it's certainly an interesting one.
Yeah.
And so the effect was eventually it had to go back after the Court of Appeal and after the Supreme Court of Canada. It had to go back because people were unclear about what it meant for the wife to basically have a mortgage over the business's place of business. And so the same judge had clarified that the corporation basically had 4 years to pay the wife out her settlement payment, which was a few $1 million, and had to pay at least 25% per year. The corporation did have cash in its bank account, but it was a research company that received a lot of money from grants. So I couldn't really tell from the decision whether that cash was actually available or not, or whether if they only get paid sporadically. Does that mean that they can't pay their employees if they pay that? Will they have to wind down? Who knows? Because the follow-up decision was only a few months ago. So who knows what will happen here? But it's a good reminder to try to treat a spouse as fairly as possible. And the court did set out some factors to consider when doing something like this. So whether the shareholders are present, what kind of company is it? Is it a family business or a publicly traded company? What are the reasonable expectations of the other shareholders? Have the spouses pulled out money before for things like vacation properties? Were the other shareholders bona fide purchasers for value? Here there actually was, in one of the related decisions, there was a mention about how the other shareholders had at one point put up a couple $1 million for shares. So it did look like they're bona fide. I don't think that was a debate. And the court can consider any other relevant factor. So one final thing I'll say is that if you run into a situation where it's a divorce involving a business, one idea might be to keep it outside of the court, because you might have noticed that there's a lot of uncertainty, a lot of unpredictability. These are all trial decisions where a judge most of these are trial decisions where a judge had a lot of time to consider things. But when you're in smaller court hearings where the court has limited time to look into it, you don't know if your judge ever practiced family law before, don't know if they're aware of all the specific rules that apply to businesses. So one option might be to hire a family law arbitrator, a senior family law lawyer who has a lot of experience dealing with businesses in the family law context. So something to think about.
Yeah.
Oh, I've got a slide asking if there's any questions. I guess people can't really do that, hey?
Nope, that's after.
Well, for those of you in the class, we've got a follow-up class where we're able to ask questions and touch on a few issues, so we can use that time to discuss things. But otherwise, anything else to add, Raj?
No, I just wanted to say I wanted to thank you for the chance to attend. I learned a lot through the material here, just listening to, and it's really practical, actually. Like from my perspective and my seat as an expert or someone who does the business valuation guideline income, lots of practical material here in terms of how to handle these issues here. So it's good stuff for when you get into the real world.
Thanks, Raj. And we're incredibly lucky to have you throughout this. We're very fortunate to have an expert who's also has great people skills for an accountant.
Oh, geez. No, we usually look at our shoes. We're usually pretty hard to pick our head up from our shoes here. So I'm into that. I'm in that category too. But I appreciate it. I'll take it while I can.
Well, it's been a pleasure joking with you about the intersection of family law and business law, I guess, and
yes,
valuations, and yeah, pleasure to have you.
Two shots at the farmers, our friends, the farmers here.
An endless source of puns.
Yes, they are. Yeah, exactly. Those were good.
Good people.
And the cakes were amazing. Yeah.
Okay, perfect.
Yeah.
All right then. Thanks so much.
Thank you.
Time.
Yeah.